Yes, sir.
blockchain that has, sub-second.
Indeed, we are live.
Finality that makes
Man,
it very,
the Fed is
send the
hosting
money,
its own
boom,
crypto
it's
conference.
done. You don't have to wait.
Insane.
There's no probability. There's no 51%
Absolutely
attack concern.
insane.
Using something that's very stable like a USDC as gas. And
let's confirm that we got audio,
including privacy
everything's
layers.
good.
So it's just very important to say you got to combine the programmability.
We're gonna get to our guests here in a little bit. We've got a banger show.
To really unlock these use cases.
𝘗𝘗, who put together like a 7-piece retrospective on Black Friday last week. Also, market is pumping.
One point of encouragement for anybody who is building,
Fed hosting its own crypto conference has to be bullish. But also, we're seeing a turnaround in the gold market, and
automate payment workflows.
wow, we are pumping
total revenue the bank does
back above 4K.
People who utilize software to eliminate some manual step, whether it's recon or payment scheduling or otherwise. There's a lot you can do with programmability that is technically better than people using bill pay services to schedule a payment, right? But it has to be much better in order for people to change the behavior. Like the law of good enough works against any new technology, because if the existing method works well.
All right, we're going to get to our guests here in about 15 minutes, but had to jump on a little bit early for you guys, bringing you the Fed payments.
You have to be able to demonstrate some significantly better value. So demonstrating programmability, showing people, hey, you can program the payment so that it moves consistent with your payment contract is not meaningfully better than just pre-programming your whatever sourcing software you're using to initiate an ACH instruction at the point in time when you've hit the date that the payment is due. You have to actually focus on the integration, right? That is the place where you can improve a step. So instead of having to pass contracts and have somebody sitting in a bullpen somewhere working AP files, that there are agreements that are standardized at the time of the procurement that then pass straight through to the financial institution or the wallet provider that then automates.
Very cool that
that's the step we're going to have to take
the
here.
Fed
just because
is
we
hosting
can,
its own
mean
crypto
anybody
conference.
will.
Who would have thought that this would have ever happened?
All right, and then I think we have a follow-on here for Heath. What's actually production ready now for enterprises, and specifically around things like illicit activity detection and where are false positives still going to bite us?
Yeah, so the whole area of making sure you're on something that's trusted, right, is in many ways critical for enterprise adoption, right? And enterprise is going to is going to be extremely hesitant to risk its reputation to go on a blockchain where potentially North Korea is a validator, right? And so there are
always worried about North Korea.
Factors like that we're taking into account. So for example, ARC, the blockchain that we're creating, will actually have permission validators. So everyone will be vetted in advance. And also making sure that the institution that you're getting the digital assets from has an AML CTF program, it's compliant with the Patriot Act, all of those things matter.
All right, next up we're going to interoperability and orchestration. This one's for all of y'all, so feel free to jump in. Keep it clean out there, boys. Where
these DeFi guys and these TradFi guys just keep clowning one another. Kyle Samani just clowning the 9th biggest bank in the world.
Actually, I can get started from the consumer standpoint. At the end of the day, it's not so expensive to maintain some liquidity buffers to orchestrate, because even today, it's still pretty aggregated. Like, the question is, what happens if we end up in one of these ridiculous situations where it's so atomized, but right now, from the consumer standpoint, I would say we don't see that being a big issue. You need to hold some liquidity buffers, but again, you don't really have FX exposure. You have some credit risk that you need to manage, but we haven't encountered that being a big problem. No. Keen to see on the scale side, how do you guys perceive it? No, but on our end, it hasn't been a big deal.
Given the interest that we express in cross-border payments, it's the on-ramps and the off-ramps. It's the point you made earlier about the need to cobble together your own ecosystem if you want to move money utilizing stablecoins today. The actual use of the rail is much easier than getting money in and then getting it out in another jurisdiction, ensuring that the person that you're paying has the ability to accept it and to convert it back to fiat. My big fear, like, I think there are lots of really interesting things that can be done with tokenized deposits, but that's the place where I think the interoperability issue is the biggest. If we can land on a handful of, call it standard stablecoin payment rails, I don't know that interoperability is a problem so much as it is just getting to a point where the adoption on both sides of the network, on the send and the receive side, are native as opposed to through a third party and then a transfer.
We're in a bit of a strange interregnum where the Genius Act has passed, and you can be forward-looking Genius compliant, but you aren't Genius compliant today, and so that's actually created a huge proliferation of stablecoin issuers from a white label side and otherwise. And so I actually think if you had a moment of risk where something could go wrong, it's probably now, between now and 18 months from now, because you have so many different firms that are operating in ways that may or may not end up looking like they've aged well. But I do think that once Genius comes into effect, when the rules are put into place and everyone is have to follow them, which I guess gets you all the way to 3 years from when it passed, you're going to have a clear set of rules, and that should create a level of fungibility that can be relied upon as long as the standards are widely enforced, and I think also adopted in a number of different international jurisdictions, so that you create this capacity where it is truly cash and cash equivalents. I think that's where we'll go. And so between blockchain and standards, you do create a capacity to have interoperability in a forward-looking basis. You don't today, because stablecoins still have counterparty risk to them, depending on exactly how they're constructed. Most of them still do, and certainly a lot of the new ones also do as well. And so that's where there's a real interesting dynamic that exists right now. I think that also, and this is really, I think, Tim's point, there is a lot of complexity around having to be able to manage that liquidity, because those are not the same liabilities. They're almost, in some ways, akin, though not the exact same thing as a deposit, because you have the counterparty risk related to them. I think that'll all get worked out over time, and we'll get to that end state where I think that will lessen maybe either the capital that you might have to hold against stable coins, the amount of risk limits that you would have to put into place.
Boys are fired up today.
Charges that you might need to carry, but I don't think we're there yet. So we're
I love
there.
seeing these guys that shitpost on Twitter all day in suits up there with
You
the
asked about orchestration. I think, and
the best
this
of
goes
them.
to sort of Tim's point about sort of not unsolving problems that have been solved. A lot of the domestic payment system works rather well. There are obviously improvements that can be made, but once you step outside U.S. borders, it becomes a lot more complex. So one example of orchestration is something we've created called the Circle Payments Network, where we have institutions on various sides that are orchestrating FX flows using what Governor Waller has called the stablecoin sandwich. But right now, to send money to Brazil from the United
Stablecoin
States or from the
sandwich.
European Union to the United States, it can take up to 72 hours going through various correspondent bank accounts. We've been able to get that down to 72 seconds using basically fiat on either end and then the stablecoin rails in between. So it's a great example of where orchestration, as you asked the question, actually can make a difference to solve a problem that is a real barrier to use case. The other point I just want to think about is tokenized deposits. We've mentioned it a couple of times. There's a couple lines in the Genius Act that just gives a scant reference to it, but this country has never really thought about tokenized deposits and the potential impact on the banking system. And as a former regulator myself, I'd ask the question, I think you used the term, used 996 banks in the United States. Yeah. If in fact, 5,000 banks in the United States, many of which are community and smaller banks, immediately overnight tokenize their deposits, they moved at the speed of the internet 24/7, as a bank regulator, I might be a little concerned about that, right? And so I think if we are going to go down the road of tokenized deposits, unlike stable coins that are backed one-to-one with very high-quality liquid assets, if we're using the fractional reserve banking system, which is subject to deposit insurance, the discount window, and essentially a government intervention model, and we're going to tokenize that and move it quickly through blockchains, I think more public policy work should be done.
All right, and then we're getting to the last question here before we open it up for Q&A. This is for all of y'all, so please jump in. Great tech always lets you do old things better and some new things that you couldn't do before. Could y'all each please give one example of a use case that you think are going to become possible using stablecoins in the next 1 to 2 years that are maybe not possible today? And maybe as a bonus if you want to get AI agents in there somehow. But y'all go for it.
I guess I can get started, but it was kind of mentioned already by Tim before, but the idea of having a large financial institution initiating a transaction on blockchain is literally a game changer. Because you suddenly move into 24/7 money movement made instant, right? So I think that would be like the biggest change to expect on that side, I would say.
I'm really excited about the potential for fungible collateral that can move around the world and across exchanges and otherwise. We have a couple of clients who run large exchanges who are exploring that sort of mobility, and it would make a material difference to the institutional investors and counterparties that trade on those exchanges.
I think one of the interesting components is that if you really kind of look at the dollar on a first principles basis, it's basically a wrapper. It's kind of a wrapper today for government securities, maybe some gold, some other things that are on the Fed balance sheet. It's a wrapper, and but essentially a stable coin is an even smaller subset of what the dollar is. It's basically only cash and cash equivalents, only T-bills, only overnight repo, and some bank cash. And you can imagine once you start having tokenized treasuries and tokenized repo, as Tim was saying, you can actually completely change the way in which the collateral mechanisms work for how you could run repo programs, how you'd be able to instantaneously be able to create a stable coin on chain. A lot of the frictional elements of stable coins start to disappear. It actually becomes quite democratized, and I think
this is pretty insane.
So many
These
questions
guys
come up around
the Fed governor that
pay interest, and I think the Genius Act struck a good
opened
compromise
up
there.
this conference
But in some
and put on
ways,
this
I think
said that they're removing the
really
need for
just
intermediary
becomes,
banks
a
to
bit of a
access
sideshow
Fed
when you
rails,
have tokenized
meaning
treasuries,
that crypto
because
banks,
you're then
stablecoin
able to
issuers,
immediately
regional banks,
swap
national
in and
banks,
out
any
of
eligible
something that's
institution
giving you yield into something that
will be able to
isn't giving you
interact
yield.
directly with the
And
Fed.
So then, you
And
can
so they're
have that artificial construct, which makes
closing
sense,
the gap
in
and
some
making
sense.
the distance
But,
between
it's not
stablecoin
really the
issuers
ultimate end
and the
space for
origination of
what
money,
stablecoins
literally
could
the
look
money
like, or
printer.
even
They're
the financial
closing
system
that
could
gap
look
and
like,
making it as
because
short a
you can
distance
have
as
the underlying
possible
assets themselves be able
so
to
that
move just like a
stablecoin issuers have greater access to capital.
One area you asked specifically about AI that I think about, and this may be beyond 12 to 18 months, but there are people right now that are thinking through these issues and working on them, is sort of the economics of AI itself, right? If I have a website, an encyclopedia, and AI is visiting that website, calling data from it, it's possible in the future no one will visit my website anymore. So I'm a producer of data, I'm a producer of content, and at some point you've got to interact with the AI and perhaps charge something, and I can't help but think that agentic payments plus programmable money, stable coins, could play a role in that whole new emerging economic system that we're still trying to figure out.
All righty, and now we'll jump into Q&A. Our first question here, of course, is coming from Anonymous. This one's for Charles and Heath. Fast forwarding a decade, how do you think proof of reserves will work, and how will it be different from how it works today?
Well, the good news is we've got the Genius Act. That'll be implemented. So we'll have the transparency that's there. But I think if you potentially combine that with AI agents and zero-knowledge proofs, there could be something there as well. But right now, the Genius Act solves that through transparency, through audits, or sort of the old-fashioned way. It's entirely possible there could be other ways of making sure that those reserves are confirmed as well.
The way it works today is, I think Circle and us, we do monthly attestations. We have KPMG, and they look at what's in the bank accounts, which is actually the hard part, and then they look what's on chain, and they say, yes, that matches up. And you could try to do that more frequently, but it's actually the complexity is not what's on chain, it's what's off chain. And how do you get that snapshot and be able to get it reliably. And maybe the way I was just answering the prior prompt, is that when you start having the underlying assets on chain, for the stablecoin, well, then, it's very simple. It's like very easy to do that match and be able to see it completely directly in real time at all times. And so I don't think it's going to take 10 years to get there. I think, the tokenized treasury market is already starting to grow, and it could be quite significant in a relatively short period of time. I could imagine in something like 3 or 4 years, a situation where, maybe the percentage of your reserves for a stablecoin that are not held in on-chain format could be quite low. But ultimately, you have to have it be 100% in order to be able to really have it be 100% matched, same to same. But I certainly think we're going to get there.
All right. Next one here is for large volume financial market settlements. What resilience features should stablecoins have beyond those required in the Genius Act? This one's for anybody. Maybe the Genius Act is perfect. All right, I guess no one's got anything. Genius Act is perfect. There you go. Thank you, Senator Haggerty and team. All right, Chad, here's the question you were expecting, of course. With the problems last week, what went wrong with the minting process? Did the blockchain work as expected? And I guess for context, for those that don't know, I think last week PayPal, for 24 minutes or thereabouts, printed 300 trillion dollars and then unprinted them.
We printed it, actually. Don't cast aspersions here. The mistake was entirely ours. Certainly, we didn't operate at the standards that we expect of ourselves. There's an interesting situation where you try to determine where does it make sense to be fully automated and where does it make sense to have manual interventions in order to be able to create additional levels of security. And in this case, our operational manual processes were put into place for a deliberate reason in terms of being able to create very secure cold minting processes, but it's something that we rarely use. And so that led to an error in how much was minted. We knew within a minute or two it all was contained on our system. It never left our system, which, by the way, should never diminish how seriously we take this. But it did, of course, lead to there being an overmint of a fantastically large number, and of course the unwind of it. I think that the importance of this to me is it underscores the value of the blockchain. It actually shows the transparency that you can immediately have into what's going on. And so in this case, an operational error that was entirely internal to our systems is now immediately visible to everybody. So I'm sitting here, of course, talking about this and making it really clear about what we could do better. But that's important because that means you can have this level of transparency throughout the entire financial system over time. That's a really positive thing. It's, of course, painful to go through, but I think you could just imagine having a world where you would be able to see exactly what's happening in real time and being able to have that level of transparency to understand how firms are functioning. And that can create confidence in the financial system in a way that the opacity that exists today has really limited. And that's why you get accelerator effects, and that's why you get run on banks, is because you don't know what you don't know. And so you're never going to have a perfect world where everything is completely transparent, but the more transparency you have, I think the better the financial system will be over time.
All right, I think we have time for maybe one more question in here. And of course, this is a nice phone one for us to wrap it up. If stablecoin issuers can theoretically have Fed payment accounts themselves, what need is there for banks in the workflow?
Well, there is a big value in intermediation, right? And if you don't have bank deposits, then the bakery perhaps cannot get a loan. And there's a massive value in that. And I think like anyone who's rejecting that value is not really understanding how the economy works, no? So of course there would be a lot of value for banks, no? And perhaps this might be like a sort of Marxist view, no? But if stablecoins eventually bring transactional value to cost to zero, and the margins get compressed in transactional business, perhaps the implication would be that financial technology will be all about balance sheet in the end, right? So perhaps the question will be the opposite, and banks will be even more important.
Let me just leave it at that. I don't know that. I think the point that you made, Fernando, that's dead on is I don't know how much people understand about the business, and not just the role that we play as a safekeeper of deposits, but as a provider of multiple payment services, as a lender.
Ask these guys, what role do banks play if we close the intermediaries?
Perspective.
Why do you need to exist?
To your
Please
point.
justify your existence.
And I just think at the end of the day, all complex ecosystems require integrators. Okay, they just do, and they're, for the average individual, potentially short of healthcare, is no more complex, opaque, harder to navigate ecosystem than managing your personal finances. And the byproduct of that is, with the exception of people who live day to day, there will be values to bundling and to the build out of, there will be value to bundling and to the build out of services around the actual currency itself. Because if that wasn't the case, then, you know, for the last 50 or 100 years, we would have just been carrying stacks of cash around in wheelbarrows, right?
And maybe I'll add my 2 cents with 2 hats on. First, my Circle hat, then as a former regulator. So wearing my Circle hat, I mean, we put billions back into the banking system. It's really important to us that we're able to put money back into the banking system. So it is, in fact, continuing to do.
Guys, welcome back to the bull market.
Credit intermediation.
Took a little time off there for about
we are very supportive of that. The last thing
week
we
and a
want
half.
to do is have a situation where the banking system is disintermediated, right? Stable coins are meant to be a payment mechanism, meant to be a version of cash. Wearing my former regulator hat, there are, however, certain instances, and I witnessed those as CFTC chairman during the COVID crisis, where our clearinghouses in the United States, the large, important financial market utilities, that didn't necessarily have a Title VIII designation and therefore didn't have Fed accounts, found themselves awash with cash, tons of cash with variation in initial margin, with no place to put it. Because the banks, to argue your point, your point out there is the supplemental leverage ratio disincentivized banks to hold cash. And therefore, we had a scenario where the clearinghouses had all this cash on hand, banks didn't want to take the cash, and we were in a major conundrum. So I would say there are instances where having a deposit-only account, not discount window access, not any kind of, you know, borrowing facilities, but just a safe place to put cash in certain circumstances would probably provide a stability backstop for the stablecoin industry.
I also think, you know, one of the important benefits of Genius and having payment stablecoins is that you can now separate fractional money, which I think is very important, from money that you're using in the payment system. And so having non-fractional money that is able to move through the payment system creates a capacity for there to be more resilience in financial crisis, where you can have accelerator effects or you can have run on banks. And when they were conjoined together, which they really had to be because of just the limitations from a technological standpoint, you know, you had whole parts of the payment system that were locking up when certain banks were having problems. And actually having some capacity to have those not be totally intertwined can be very effective in times where I think there are systemic risks that really become endemic in the system. And certainly part of that could be having use of a Fed master account. And it doesn't even have to be necessarily going in, being able to go into debit at the Fed. It's simply being able to have funds that you're able to put at the Fed. And so in that way, you can not necessarily disintermediate the banking system, but you can create a mechanism for intermediation to continue through the payment system, even when there are times of stress.
All right, actually, we do have a few more minutes. I misread the clock. So a couple more for y'all guys. Any thoughts from this group on how the issue of revocability might be addressed in the stablecoin ecosystem?
𝘗𝘯𝘓𝗧𝗏 having trouble saying words.
It's probably for me.
Revocability.
Yeah, so it's very important that transactions on blockchains are irrevocable. And as I said before, one of the things that the Basel Committee and others have said
It's a shame not to have Paolo up here.
Blockchains is the fact
USDC
you have
and
the
Circle still has a
possibility of
regulatory
having,
moat.
51% attacks, and you have probabilistic settlement as opposed to final deterministic settlement. So no question that anytime something is on a blockchain, we really do need settlement finality. That's a separate issue than the one which is in a world of consumer payments where chargebacks have become an important part of the way that our consumer payment system works. Is there the ability to create some kind of opt-in as an application layer on a blockchain to facilitate chargebacks, right? To bring some of those great things that we have in the scaled financial system of today into the Web3 world. So that's the way I think it's an entire, if there is a need for something like that, it would be done through an application layer that everyone would opt into voluntarily, and at the same time preserving the irrevocable nature of the underlying blockchain transaction.
All right, going down the list here.
I think there's a really interesting question on this one because
this Fifth Third bank guy is clearly a pro.
Like
This guy
there are
knows
some
exactly what he's doing.
use cases that are not amenable to being switched, right? I think one of the things that drives me nuts is whenever we try to compare the cost of accepting a stable coin to the cost of accepting a credit card payment, because if the decision on what sort of payment to accept was entirely in the hands of the merchant, right, they wouldn't be accepting credit cards today. The reason they accept credit cards is because people want to pay with them. And people want to pay with them because they want float or credit or rewards or the consumer protection associated with the ability to charge back a payment that you didn't make, right? So those are features of the product. We've spent too much time on and those features require economics to be able to provide them, right? It's simple utility. And the economics around the payment, then are attached to the provision of those sorts of features. And my own personal view on this one is we could spend a lot of time to replicate the feature functionality of all the different legacy payment methods and get nowhere, because what would happen is the cost to accept a stablecoin would have to go up in order to support all of these sorts of benefits. And in turn, you wouldn't see any sort of value shift. Whereas we have payments that move today in places where revocability isn't a requirement, right? It's not a valuable feature. And just mining those markets has got to be a huge TAM for people who are out there. So trying to get every rail to do everything doesn't seem to me to be the right long-term solution. Given that the rail that exists, the tech that exists today, there's a massive capacity overhang to do things where some of the things it can't do aren't a big problem.
How did no one call out when they're talking about irrevocability? They didn't refer back to the 300 trillion that got minted by PayPal.
Leverage stablecoins,
like that was an example of revoking these coins from the chain.
Man, I feel like that one's mine. I'm fond of. I think it's one of the A16Z folks, but the saying that the sort of battle for any market comes down to whether the incumbents get the innovation faster than the disruptors get distribution, right? And that's what you're going to see with all of the legacy payment utilities here, is that legacy payment utilities have to find a way to rewire around new technologies, new protocols, faster than the
all right, we got YQ in the back. We're live. We went live a little bit early today so we could watch this Fed crypto conference.
I don't know that I would handicap that,
but we're gonna get YQ up. Just been reacting to these guys. 𝘗𝘯𝘓𝗧𝗏𝘠 taking on the suits. He's in a suit. All right, whenever we're ready, let's get YQ going. Beauty. Here he is. YQ, welcome. Dude, so much has happened. We had an entire bear market, and now we've resumed the bull market since you started posting about Black Friday. You wrote like a 7-part epic book about Black Friday, man. And now we're starting to recover. I don't know if it's the gold rotation. I don't know if it's this Fed conference, people signaling like there's real adoption here. Before we get into the more recent bullishness that has taken part over the last few hours, really, it's super recent that these things are rebounding. Let's go all the way back to what, 10 days ago? And
yeah, it's exactly 10 days ago. Yeah,
exactly 10 days ago. you put together a ton of content, essentially reconciling what happened during this Black Friday crash, the auto deleveraging. We're still seeing things come out. Saw something today about a Binance market maker that effectively got his positions closed. He had a risk management system that worked for something like 4 years, and then all of a sudden it just broke on Black Friday. You know, we've since that happened, we've talked a lot about auto deleveraging and kind of like picking up the pieces. But what do you think are some of the most important takeaways as an industry so that we avoid anything like that ever happening again and we can rebuild going forward?
Yeah. So yeah, thanks for the invite. As Robbie mentioned, right? Somehow exactly during this episode, the market has a very strong recovery. I mean, I literally saw Bitcoin like rise to like I think 110 or something $1,000 right now. I mean, yeah. The thing as Robbie mentioned, right? Like exactly like 10 days ago, we had this Black Friday. I don't know why it's always Black Friday. You know, it's not
It's always
like,
a Friday.
like Thursday or Black Monday or something.
Crazy.
But like when we dig into like sort of a lot of these details, we figure out like actually it was two major liquidations. The first one around like sort of I will use the Singapore time zone. It's around like 5:20 a.m. On Saturday, and I think it's like 9:20 something p.m. In this US time zone. And then like sort of it was a first round of liquidation, like basically major on all the majors, Bitcoin, ETH, and later on like sort of down 80 or 90% of all coins. Somehow at that time I was still awake, and I literally watching like sort of these waterfalls of all the altcoins, like even this Atom, right, this Cosmos token down to almost zero. That's sort of the first liquidation, and then there was the second one. Second one is basically the depegging of USDE, 𝘵𝘳𝘀, and also WBETH.
Yep.
So we really like sort of until right now, as Robbie mentioned, right? People are still trying to figure out like, sort of what are the root causes. And based on the existing materials and also some statements from Binance and also from different exchanges, DEX, we found that for the first liquidation, it's sort of like a bunch of interesting like sort of findings. The first thing, of course, this tariff sort of announcement, and after that, a bunch of market makers withdraw the liquidity. And after that, like sort of, there's a lot of this kind of liquidation happening on Binance and a bunch of the CEX and DEX. And after that, it triggered these different ADLs. And then the system became super busy. And then like sort of a lot of market makers couldn't even place bids, or they couldn't even withdraw the liquidity. So in that case, like we saw this kind of a liquidity vacuum. And basically that further caused this downside of these a lot of coins, and then we saw the first liquidation during that day. And then after that, we figure out like, okay, after like around 10 to 20 minutes, right, around this 5:43, we saw the second major liquidation on USDE, basically causing a depeg. There was around like over $60 million worth of tokens or USDE got dumped on like sort of Binance and different exchanges, and then it caused the depeg on sort of Binance. After that, basically you can see we got a lot of collaterals from this 𝘵𝘳𝘀 and also this WBETH, and then we further saw this kind of depeg of these assets, since they are not like 100% like sort of packed into ETH or the state ETH or state SOL, and also there was an announcement like sort of 1 week before this kind of liquidation, saying that Binance is trying to fix like sort of the index price for 𝘵𝘳𝘀 and also WBETH. So that's why we feel like it can be a coordinated attack on these sort of like collaterals and a further attack on Ethena. So then that's sort of like the somehow like a root cause of the second liquidation, basically depegging, because a lot of these assets, their index price actually is composing of different Oracle data, one of them very important part is the spot price from the sort of the exchange. So because a lot of dumping pressure at that time, so a little bit deep hike on the spot price, and after that, it caused this kind of cascading liquidation of a lot of users accounts, because a lot of the accounts, they are cross margin. It's basically a unified account.
Right.
If one sort of token down super bad, and if you have some lending and borrowing at the same time, also you use it for perp, and in that case, you easily cause this cascading sort of liquidation. So far, that's sort of the analysis for these two liquidations. One is mainly on the sort of these altcoins, and the second one is mainly on this kind of USDE being sold on the WBETH. And the root cause are quite different. The first one, I would say, sort of these downgraded services of CEX, DEX, and also the market maker liquidity vacuum. The second one, I think mainly about this Oracle depegging, and really caused a lot of these assets got further liquidity, and then cause a massive sort of cascading liquidation. And then, as you can see, right, it's basically make this Black Friday as the biggest crash so far in this crypto history.
Bigger than FTX.
I think it's around $20 billion, even more, because a lot of people saying that a lot of data from CEX are not correct.
Right.
Basically, they are not reported. Yeah.
Man, one of the things that you mentioned is that, Atom fell almost to zero. There were other coins that fell significantly more than, I'm not a big fan of Atom, but I'd be buying Atom at 1 cent. You probably same for you, but you're saying that they couldn't place bids. No one could place bids, and what you're saying is that we couldn't place bids because there was downtime, right? There was Binance was down, Coinbase, Robinhood, everyone kind of had deprecated services as a result of the load that was going through the system at any given time. Is that what led or are you suggesting that there was more nefarious or malicious purposes as to why people weren't able to place bids?
So because most of these kind of cases right now are still black box, there's not many open source evidence, but based on the statements from Binance and a lot of these market makers statements, we can sort of be sure that there will be there was sort of downgraded services. It was not downtime, because people can still send bids. Probably you watched the podcast from Wintermute, right? I just 2 days ago. They were saying that they can still play bids. It's just out of 100%, probably 10 to 20% bids still went through. That's why I use a term called downgraded services.
Downgraded services. Okay.
Yeah. So in that case, because these kind of downgraded services, and also a lot of this liquidation happening, right? And some market makers, as I mentioned in the article, basically it disturbed their original strategy. So a lot of them just withdraw their liquidity. So previously, that's one of the reasons why they wanted to withdraw the liquidity. The second thing is because the ADL, right, basically closed a lot of their short positions, and then they couldn't do hedge on the long position, because long position make them lose a lot of money, right?
Yeah.
For example, Wintermute hold a lot of long position either on perp or on spot, but all their short positions already got closed by the ADL,
right?
Either on the CEX or DEX Hyperliquid. So in that case, they couldn't really hedge properly. So that's why another reason caused a lot of market makers to withdraw their liquidity, caused this kind of liquidity vacuum. So that's why it's not you couldn't place a bid. It's I also want to place a bid at that time, but the thing is due to the downgraded services, some of the bids went through, but some of the bids didn't go through. And of course, people always wanted to have the cheap sort of assets, right? But the thing is at that time, it's really everything in a mess, and it's not clear how sort of the exchanges handle this kind of situation. Yeah.
Of course, I mean, what they call it, catching knives, right? That's the old thing. It's it's dangerous work. I didn't get too risky. I bought a little bit of Bitcoin under 110, maybe like 105, 107. Nothing on the altcoins. It's too difficult to really time the market like that. Looking at more of the infrastructure, I'm curious, Binance had the exclusive arrangement with ADL and not ADLing Athena. This came out afterwards. Hyperliquid came out and effectively said, look, everything worked as it was intended. HLP made, a significant amount of money, but a lot of traders got liquidated and in ADL'd. Lighter came out. They said, look, we had downtime, but we didn't liquidate a lot of people. LLP actually took a loss. I don't know how much leverage trading you do if you trade on perps or margin or anything like that. But if let's say you are 𝘠𝘠𝘦𝘴𝘵 or you're a market maker, YQ, and you're looking at where to trade and where to conduct most of your market making business, out of Binance, Lighter, Hyperliquid, which venue do you think stood up the best and had the best performance during the market crash? Going forward, if you're a market maker or a margin trader on perps, where would you be trading?
It's a really great question. I talked to a bunch of my friends, some of them doing this liquid fund and some of them doing this market making. The thing is like, I think still all of them trust most of these centralized exchanges. Right, because of these regulation issues, whatever. If you really have a lot of funds, like somehow you really need to diversify into multiple sort of exchanges. You won't really put everything into Binance or put into Hyperliquid, but you can diversify, like probably 20 here, another 20 there. The thing is like, I just feel like this kind of a case, like the Black Friday this time, right? It was really the extreme case. Like sort of the server or Binance, they really like sort of handle like probably I would say tons of millions of requests per second at that time. If you put that kind of volume into any perp DEX, I couldn't think like sort of they can handle it probably right now. So that's why in another article I mentioned, right, it's not just about one CEX not handling very well. Even like sort of we put all the this volume into all different CEX or DX. I doubt any of them can really handle it properly because the volume is really like a DDoS, Like if you like sort of is immediately within a few seconds you got too much volume and traffic. How you can scale that? I mean, as you can see, right, AWS was down again yesterday. So I mean, even the Web2 infrastructure couldn't really sometimes handle like sort of the volume properly. It's like that's why in the article I mentioned we need a lot of redundancy and a lot of decentralization for infrastructure as much as possible. So in that case, if one point is down, right, or downgrade services, but at least immediately you can auto scale as many services as possible, handle the traffic. But back to the point, right? I don't really do a lot of library trading, but I use perp. I mean, this Hyperliquid, Lighter, Binance, and OKX, all these kind of doing like sort of some hedge. The main issue is like all the exchanges, right? Even the perp DEX like Hyperliquid, the ADL algorithm is public, but the problem is like how they execute. Like they typically have a black box procedure. Like for example, for CEX like Binance, right? The ADL actually was the last line of defense. They have this false liquidation. They also have the insurance fund.
Right.
And if all the things not working, and then they trigger ADL. But for some of the perp DEX, for example, Hyperliquid, they will trigger ADL before like sort of like your assist like your HLP to take over. Of course, previously, 𝘱𝘰𝘮𝘰, right?
Yeah.
You got the HLP took over too early and then got some loss. But then later they changed the algorithm. So all these like are dynamic. Same to Lighter. Lighter actually, even we complain a lot, the down like service was down, but somehow LLP was used in a correct order. So basically, LLP was used as an insurance fund. They took over all these kind of positions and then took the loss without trigger this ADL. So that means like you really have the insurance fund to like sort of handle this kind of loss in general. But as you can see, right, community won't be happy about it. I also like sort of got some loss there. But the thing is like that sort of this kind of liquidation or this kind of protection mechanism they have on their side. We like based on the analysis I did that none of these exchanges have the same sort of procedure of this liquidation or forced liquidation insurance and ADL mechanism. But in general, as I mentioned, right, I think the best way we can do, of course, we don't have a 24/7 team to manage all this kind of hedge stuff. If we only have ourselves, right, I still recommend we should really diversify our positions across different like CEX or DEX. So in that case, at least if one place, like due to various reasons, couldn't handle like sort of the live traffic, but and then we can still like sort of do a lot of hedge on the other places. Yeah.
You know what the issue is though, because it's cross margin. You know, you can get cross margin across assets, but you can't get them across venues. And so once you start fragmenting liquidity, you end up with less collateral for positions to hedge and do these things.
Yeah, you're right. I believe there's some projects, at least some of my friends are trying to build something like that. But after
where
a lot of discussions,
they can unify liquidity across venues.
The biggest issue is about the capital efficiency.
Right.
Like for example, on Hyperliquid, the only collateral they accept is USDC, right?
Right.
But on Binance or some CEX, you can put all coins as your collateral.
Right.
You get my point, right? It's not like about like sort of. So that's a capital efficiency we always highlight. You can buy the token and put as a collateral, and then you can learn more tokens, or you can use these collaterals as a margin, and then you can do 50x on the perp. But you couldn't do it cross exchange because like different exchange accepting different like sort of collaterals. And beyond that, it's also about like, for example, if because the market price on different exchange is different. For example, for Lighter, right? Lighter, if you check the market price for BTC right now, it's quite different from Hyperliquid, also from this Binance, because it's correlated to the volume and also these positions on your own exchange. You can't easily say that, okay, I can directly use the market price from Binance because the long position, short position on your exchange are quite different.
Right.
So that's why, like, did you remember a few months ago, there was like sort of this short squeeze on Plasma on Hyperliquid.
Yes, and they said Justin Sun.
The pre-market price manipulation, right?
Right. They said Justin Sun was the one that tried to manipulate it.
Yeah, it's original. The price was 0.6, and then people pump it, I think, to a few dollars.
Yeah, like $2
$5,
or $3,
$10. So in that case, there was no way for you to do hedge.
Right. No, you couldn't. You get
even
blown out.
0.1 per 0.1 like sort of like even you just have a 10% like sort of long, right? Like your position still got liquidated.
Yeah.
But this only happened on Hyperliquid.
Right.
So that's why like you do this cross margin, cross exchange so difficult because like
I see what you're saying. You can actually use the price dislocation to your advantage as a way of isolating a certain portion of your collateral, just if there was an Oracle exploit or if there was some sort of quote or price feed manipulation, you have a certain subset of your collateral just based on that.
Yeah, it's basically the market price. It's quite different across different exchanges.
I see.
Like that's why sometimes if you don't have enough liquidity or your Oracle has some, it may not have some problems, but like sort of the attacker has enough like sort of money for like $20 million, then you can manipulate the market. But you can only manipulate that market on Hyperliquid, but you couldn't manipulate the market on Binance. So that's the another like sort of difficulty if you want to do this cross margin, cross exchange, this kind of hedge or arbitrage. Yeah.
Understood. YQ, just another question or two. Fast forwarding, 10 days forward to today, things have changed. Like, I don't know about you. Did you expect things to rebound? So now ETH is back above 4K. Bitcoin is, headed back around 115. Did you think this was going to happen so quickly, or did you think that we needed to repair some of the infrastructure before we could eventually go higher?
As mentioned, like in one of my tweets, I mentioned that right now it's a bull market for major coins like Bitcoin, Ether, and probably Sol.
Right.
But it's still a bear market for all coins, especially after the Black Friday. Like most of the liquidity for most of the altcoins actually like draw down a lot, and that's a big hurt on all these altcoin projects. Because like even we say that okay, crypto like Wall Street, like the Bitcoin, Ether, and so, but we all know that the altcoin project actually that are the small business SMEs in crypto. They are the real blood. They are the real foundation for the crypto industry. So I think it takes longer for these altcoin project to recover because a lot of this liquidity, as you can see, right? If you look at the chart, right, Bitcoin is back, Ether is back, but most of the altcoins, like basically the price is still not recover that much. Probably recover like 50%, but definitely not 100%. It will take a longer time. But beyond that, as you just mentioned, like I feel like if we really want to avoid this kind of Black Friday, we should seriously think about like how to fix these Oracle issues, especially for the perp on CEX and DEX. Because the thing is like there's some people may claim that if it's a stable coin like USD, let's just do one-to-one pegging to USDC, which I feel is not correct, because like then you take all the liability yourself. We all know that it's definitely based on the mechanism. It's not one-to-one pegging. Even USDC now one-to-one peg to USD. Like 2 years ago, we know like sort of there's some depeg, right, due to the
Silver Bay
issue.
Yeah.
And so that's sort of the issue. We should really figure out like ways to fix the Oracle issue across all different exchanges, especially perp, to avoid this market manipulation or further attacks. And beyond that, of course, as I mentioned in the article, right, we need a much more redundant and also robust infrastructure, no matter for CEX and also for the chains. So this time is a real good like sort of practice on all these infrastructure, right? We all know that it was not that robust, especially we are running this 24/7 like financial market without like sort of any stop. It's pretty like sort of critical. Beyond that, like yesterday, the AWS sort of give us another warning, right? Our blockchain is not decentralized enough. I mean, all of them, Coinbase, Robinhood, and the Base, even Base, everything is based on the Web2 cloud services.
It's all these centralized RPC providers. Infura was down, L2s went down across the board.
Yeah. It was supposed to not be that, but we can see in reality due to various like sort of reason, right? Efficiency, cost. We choose to have these centralized services to have the best user experience and the best performance. But the trade-off is like the crypto or blockchains are not decentralized enough. Sometimes it's really like a joke, because like we all promote decentralization, but in the end, somehow most of our critical services are most decentralized, most centralized. So that's a part I still feel like not just for decentralization, but even for the robustness, we should have more redundancy for all the servers, the sequencers, and the validators.
You say that's the number one issue facing our industry right now is we need more redundancy when it comes to RPCs and Oracle issuers and all of these things?
Yes, absolutely. And then the second thing, Oracle. Yeah, we should definitely fix all the Oracles here and there because like there are a lot of new tools and the new like sort of projects and interesting ideas. They all leveraging the Oracles. For example, even for prediction market, We don't call it oracle, but we all know that we need a very fair oracle, not manipulated by big players. But so far, we haven't seen any good solutions for that.
Yeah, man. Well, YQ, it was incredible to see the breadth that you took when it came to the reconciliation of the retrospective of Black Friday 10 days ago. Was any of this content, any of your writing, was it AI generated or was it all off the dome? Because there was a lot there to unpack.
So the major data and also the most of the points or whatever, I have to write a draft. And after that, like sort of we need to use like sort of a Claude and something to really polish the content.
I see.
Yeah. Otherwise, it won't be fast enough. Right now, like even inside our company, we are forcing the team to use AI as much as possible because it's much faster. Yeah. But
awesome.
But to be honest, I think the main parts, as you can see, right, it's really about the data. The most important thing is about data and also the viewpoints you have, and also the crucial content. That's a part like AI couldn't really generate for you, especially the analysis. That's the most important part.
Yeah. As we wrap up here, last question. How did Rumor react to this? Did you guys have any activity? I know it's closed beta still, right? So it's not totally open to the public, but did you guys start to see a little bit of data or rumors start to trickle in?
Yeah. So as you mentioned, right, we already saw a bunch of interesting rumors, either pre and post this kind of Black Friday, and either on this kind of market maker sort of incidents, and also some of the reports on these kind of CEX and DAX. So these are the super valuable information, like probably you can only find like sort of on Rumor. Even like last time I mentioned, right, this kind of Naver was acquiring like 𝘗𝘂. You can find basically the information on Rumor like sort of a few hours before the news was released. So that was pretty fun. Like if you just use Rumor as this kind of information terminal, or as like signal terminal. And beyond that, typically people have a lot of chats and discussions like with each other on that. Of course, if you want to trade, they also have these kind of trading features. But in general, like we can see like more and more people trying to share and also discuss like sort of new and signals and this kind of like private information on this new app.
Yeah, very cool. That's rumor.app. Guys, check it out. If you want an invite code, maybe YQ will be nice enough to give you one. Hit us up. We'll make it happen. YQ, thank you so much, man. Tons of content, a lot of really good information on the heels of, like you said, the biggest liquidation event to ever take place in crypto. It's really, really good to see that now we're starting to pick up the pieces. Asset prices are recovering. And I do have optimism that we will fix the infrastructure. And you helped highlight exactly what infrastructure needs to get fixed. The oracles, the RPCs, we need more redundancy. We need our decentralized applications to actually be decentralized. Thank you so much, man, for coming on.
Yeah, thank you. Yeah, great chatting.
Yeah, same here. We'll see you next time.
See you.
Cheers, YQ. Bang. All right, we're going to keep it moving. I think we're going to get Weak Key up in just a little bit. Great chatting with YQ, as always. A lot of great takes. We're going to get a bunch of these clips rolling out and broadcast all of this great information to you guys. I know it's getting late there for YQ, so I had to let him go. Tons of things that we can go over. Let's see. Man, I mean, we're just seeing things come out left and right. If Weekey's not ready in a few minutes, maybe we'll just hop back over to the Fed crypto conference, because there was alpha just out the wazoo. Coming fresh off the wire, Circle has launched BridgeKit, developer toolkit, designed to simplify cross-chain transfers, starting with support for CCTP. I mean, we're just seeing this. We're just seeing this coming out of the convergence between DeFi and Wall Street. This is what's coming out is we're strengthening ties between stablecoin issuers, DeFi providers, and just the bare foundational monetary rails that our current monetary system runs on. Things are getting upgraded in real time. We're no longer going to be dependent on this legacy infrastructure. We're innovating it piece by piece and iterating on it. I think one of the most incredibly bullish things to come out of the Fed conference is what Governor Waller said to open up the conference, which was that they're going to start to remove the intermediaries between stablecoin issuers and the Fed. And so the way that this works right now is you have to have a Title 8 license in order to hold cash at the Fed. And cash that's held at the Fed gets the federal funds rate, the thing that we see Jerome Powell every month comes on the stage. He says, we're going to increase the rate, we're going to decrease the rate. That's the rate that they're giving on bank deposits at the Fed. Right now, Tether, USDC, they need to go through these intermediary banks in order to acquire treasuries and hold their cash at the Fed. This, again, just reduces capital efficiency. It causes friction, and it's costing these guys money that ultimately they could pass back to the end consumer, in this case, the holders of Tether or the holders of USDC. And so by closing this gap, we're removing intermediaries that are just there for regulatory bloat. They don't really need to be there. They don't really need to provide their service, as long as we just lower the barrier of entry for bankers, for banks and stablecoin issuers to hold their money at the Fed. It's just, at this point, it's a no-brainer. We just have to iterate one piece of technology at a time. Let's see. I'm gonna hop back over. I don't know if 𝘗𝘳 is going to be able to join. Let's see. Leo, in the meantime, can we go to the Fed conference? Do we still have the stream? Okay, so the Fed conference broke for lunch. All right. Why don't we just take a look at some of the things? What I'm referencing here, Arthur Hayes had a great tweet about this. The Fed opening the door to crypto banking. Governor Chris Waller announces the central bank is proposing a new limited access or skinny master account that would give legally eligible institutions direct access to Fed's payment rails without relying on partner banks. That's a huge thing. They no longer need to rely on these partner banks and hold cash at these partner banks as kind of this pass-through for acquiring treasuries. Remember, Secretary Bessent has said they want $3 trillion in stablecoins circulating by the end of Trump's administration, 27, 28. The only way to do that is to give stablecoin issuers direct access to buying treasuries from the Fed. Maybe you guys don't know, but the way that money is originated into the system, every few weeks, maybe every week or so, the Fed auctions off treasuries. They do this at the scale of billions. And right now, there's only these Title 8 eligible institutions that are able to buy those treasuries. And they essentially gauge the demand for treasuries, and that's how this thing works. If there's not enough demand at a certain yield, they're going to have to raise the yield to incentivize these banks to buy their treasuries, and that's how you kind of get these sharp rises and falls in the treasury market. You see T-bills. We're looking at the 2-year, the 10-year, the 30-year. These are what happens. And then if the banks have to buy these treasuries at a higher rate, they have to pass on a higher rate when they lend it out. Mortgage rates go up, all these things go up. If we can have stablecoin issuers buy these things directly, we're going to see rates come down because they have a demand. They have a demand for stable coins. They have a demand for these treasury yields. And therefore, it would lower the rates that are required to issue these treasuries. We would see yields come down across the board. All right, we're going to speed run some of our guests. Let's get 𝘬𝘗 up here. So let's get 𝘬𝘗 up. We're going to speed run a quick conversation with Virtual's founder, 𝘬𝘗. And we'll get going. We'll make sure that 𝘬𝘗, we can hear him. We'll make sure that his audio is all good. Let's put him in the live room, and we'll be good to go. I already see him up, but we need to get him in the live room. We need to make sure that we can talk to him. It's an operation back here. All right. I think we've got 𝘬𝘗 coming in now. Pleasure to see you. I appreciate your patience getting set up behind the scenes. How you doing, 𝘬𝘗? Yeah, same here. Dude, I mean, just absolute legend in the flesh. Luna, co-founder of Virtuals, one of the legends behind the AI agent craze that happened in it was really like 2023, 2024, when all of these things started to take off. Man, we've only, maybe we'll get you back when we have a little bit more time, because I know you took some time to set up. But I'd love to get an understanding of what you guys have been up to. The AI agent phenomenon kind of slowed down a little bit, but you guys have continued to build. Can you just give us a sense of what you guys have been up to over the last few months? 𝘬𝘗, sorry, we don't have your audio. Not sure what the issue is. We might have to pull you back. Sorry, we're gonna get you set up. Okay. All right, we're gonna get you going. Not sure what the issue is there. Yeah. Let's see. Let's see. So what happens? Anything can happen when we're live. Anything can happen. I think we might have to reschedule with 𝘬𝘗. I think we are going to figure out what's going on with him. Let's see. The Fed conference is at lunch. They're going to be back at 1. Let's make sure that we got our systems dialed here. Okay. So, man, are we dialed? Coins are pumping. Wow, we're flying. Hyperliquid 38. Hyperliquid's kind of lagging. We're gonna have to figure that one out. But ETH, Bitcoin, I think if we get above 115, it's just off to the races. We're gonna keep pushing. Let's go. Keep pushing. I really do think if we can get Bitcoin above 115 and just establish that as some support, I mean, if just when you look at what is happening, even if you're not paying attention to technical analysis and Ben Cowan calling for 5,300, all of these personalities, look at what is happening at an institutional scale, a nation state scale. Fed is hosting crypto conferences. They're giving stablecoin issuers direct access to accounts at the Fed. This is incredibly bullish. These are things that take lots of time to play out. As we said, Circle is innovating. We're seeing this. We're iterating one piece at a time. And so it's going to take time, but you have to adjust your time horizon accordingly. Okay. Why don't we do, maybe we'll do some screen share here. Let's see. Or we got the comment cooking. Yes, but every time we get a super bullish news, we get a local top because people get bull trapped. I don't know. I mean, market's flying and we get tons of bullish news. So how are you supposed to react to that? I think, I mean, you could look at the event that we had last week and say massive liquidation, $20 billion of liquidations. We're going to be cooked. You know, beginning of a new bear market, open interest is wiped, coins have no bid, we need to rebuild spot volume, all of this. It's not what's happening. I mean, we're rebuilding in real time. Chat's cooking, great point. Seems like a lot of people are trading, not too many investing. More important to focus on bigger picture. Yes. Who is this? Ghost E-Money. Ghost E-Money, you're the GOAT, E-Money. That's on the money. I think you're right. I think what we saw was a leverage wipe. And those were the leverage traders. That was the mercenary capital. Now, the people that are still in did not use leverage and are starting to rebuild. These are guys that are sticky capital, sticky liquidity. Think about GATs. Think about guys. Okay. We're going to get Scott up in just a moment. Let's make sure. Let's bring him up. Haven't seen Scott since he came to our UF Bitcoin Club talking about making sure we don't get SIM swapped. That was a minute ago. Let's get Scott going. This one's fun. He came a little bit early, so we've got plenty of time. Scott, man, great to see you again. I remember talking to Adam. I haven't seen Adam in a few years, but he was a man. Is he he's still doing a good job? I love it. Shout out Adam. And Scott, you're a Gator, right? Sort of. Well,
19-year-old kids do on a field. I'm 48, so at some point in my like early 30s, I was like, I'm really getting angry because the team that has nothing to do with me is not winning, and these could be my children. So what am I doing here? And I kind of just gave up on caring about sports and things like that. And once you see under the hood of college sports and what they do to win, it's pretty gross. So I've kind of detached myself from the entire thing.
That's probably for the best, man. Well, there's probably something to be said about whether or not we've got more shenanigans going on at the college sports level or in the crypto Twitter echo chamber here going on. I've had a couple guys on today. One of them was YQ. We were talking about the Black Friday crash. Yes, about 10 days ago. But man, market recovering now. Generally, there's people. It feels like we've diverged, and people are at either one end of the spectrum or the other. You got people calling the top. They're saying gold is a signal, recession is coming. There's going to be no rotation. AI CapEx is slowing down. MicroStrategy slowing down. All of these things are signaling a downturn. The leverage crash wiped out all the interest. And then at the other side, you have basically a renowned bullishness. You have sticky liquidity coming in. ETH DATs are continuing to buy more DATs for long tail assets. Generally, where do you fall in this market stage conversation?
I think trying to call the market top is extremely dangerous and usually makes you look like a fool. Eventually, you're right, but you're usually poor by the time that you are. So if it ain't broke, don't try to fix it. I don't see any reason to believe that a market top is in, besides the fact that people are impatient and just think that the market has to go up every day or every week or else everything's over. we are in an environment right now where clearly we're going to be adding liquidity. And I don't take a view based on a week or a month, right? So I'm looking at a much longer cycle or longer view. Whether Powell continues to cut or not, we know exactly what's going to be happening when Powell is gone in May, and that's that Trump is going to put in some sort of puppet that'll cut rates basically back to zero. And you have at that time 7.5 trillion, a record high right now as of today, literally sitting on the sidelines in mutual funds and treasuries. All that money, when it's not seeking yield anymore, is going to have to find a home, and that's most likely to come back into our beloved assets, right? And you have a president who, whatever you think of him politically, don't really care. Whatever you think about what he says, whether it's true or whether it's not true, I do politics about as much as I do college sports at this point. I'm utterly indifferent. There's one thing that we know he and 𝗵𝘳𝑒nt and Lutnick and all these guys deeply care about, and that's everybody getting rich. Everybody at the top getting rich and seeing markets pump as a gauge for the success of his presidency. And they have had an insane amount of buttons to push and levers to pull over the past few years, the Biden administration as well, to make sure that recessions remain illegal and that markets continue to go up. So you're basically betting that there's no buttons left to push or levers left to pull right now for the dead top of everything to be in. And that could be the case. I'm just saying 9 out of 10 times when you call the top, you're going to be wrong, right? And so talking about a rotation, I don't know whether it's a gold rotation into Bitcoin. I think that idea is a bit before its time. I think it's wishful thinking a bit by Bitcoiners. I think a little of that does happen. But we do have some historical precedent that when gold tops, that's usually when Bitcoin is bottoming, and gold is having its worst day since 2013. Right now, as we're speaking, silver was down 9% today. I mean, these are like shitcoin moves. Can I say that on this show?
Absolutely.
Shitty shitcoin moves.
Yes, sir.
And, so and Bitcoin bottomed right when they were kind of topping and has risen since. So, a few hours is not a data point, but very clear that one is not necessarily dependent on the other at any given time. And maybe it's just the power of the dollar that's wrecking all of those things, right? As you see the dollar rise, but Bitcoin doing well in that environment, up to almost 114,000 here off the lows, like 107,000 at 2 a.m. this morning, Eastern Standard Time. So, I mean, where I put the market is no real reason besides disbelief that it can't continue to go up.
Yeah.
Famous saying, markets can remain irrational longer than you can remain solvent.
Yes, sir.
If you just keep calling the top, eventually you'll be right, but you probably won't have any money left. I think we're going to go certainly with Bitcoin a lot higher.
Love it. That makes a ton of sense. If you click on, we should have, if you click on the little control there in our meet, you'll see that we've got one of your tweets up in reference to what you're saying about gold and silver trading like shitcoins. Gold's on an incredible run, but the chart doesn't tell the whole story. For decades, holding gold instead of stocks has been like paying a premium on peace of mind. It's not a bad trade, but it's a costly one. It's actually returned less per year, while the S&P 500 averaged 12.2%, and it hasn't even it's underperformed inflation. It hasn't even beaten inflation. You'd have more dollars on paper, but they buy less than before. Do you think this has always been the case, that gold has performed and traded like a meme coin? Is it a shit coin? Is it essentially just a pet rock? What do you think is the play here?
I'm not saying that thread at all. I'm sorry. That's a funny notion, and I can definitely say that today because you don't usually see 6 to 10% moves on a rock that like a percent in a month is a lot, right? We've seen this massive move in gold, but that's not the norm. But the point I'm making here is that you had a 30-year period where gold didn't even outperform inflation. So it's a mean reversion catch-up trade to have gold where it is now. And it's not even remotely close to catching up if you take it on a 30, 40-year time horizon, right? Gold would have to go many multiples higher here just to have outperformed over that time period any of these other assets. So if you were holding gold as a hedge against inflation from 1980 to 2019, 30 years, you literally lost money. Like against inflation, your inflation adjusted price of gold is lower than you paid for it.
Quick follow-up, Scott. Does that mean that we've got more room to run in gold as we mean revert higher?
I think so. So like, I think that we could have a top, but not the top, right? So once again, yes, I think that gold, is historically overbought here. If you're a technician and you look at, chart analysis or RSI, it's extremely overbought. Maybe it's overshot, but you get these mean reversions. I think the daily 50 MA on gold is like 3,700. Maybe the 200 MA is 3,200. I don't know. I'm not looking at it exactly. I can actually pull it up. Yeah, the 200, it's 3,270. They're rising. So even if price comes down, retraces a bit, 37, 36, meets one of those lines, that's normal bull market retracement, but would be called a crash by anyone else's metric when you're going from, once again, on an asset that's not supposed to be volatile. If you go from 43 to 3,700, that's going to be a significant move, but still doesn't really change anything. So yes, I think you may get corrections and cool-offs, but once again, if you go back to government behavior of $38 trillion in debt, they've given up on trying to pay that down. What they've decided to do is outgrow it. And anyone who understands government speak knows that outgrow means outprint. So the goal here is to deflate. The goal here is to debase the dollar as much as possible to basically create asset inflation and to attempt to not create consumer and consumer inflation and the inflation on goods at the same time, which is a tough needle to thread that they've thread for a long time. But they're literally telling you they're going to print money to make assets go higher. So you either believe they can do it or you don't.
Right. I had a great
they can do it for a while, and then whenever it breaks big, and that's when you start talking about fourth turnings and Great Depressions and things like that. But is today the day for a Great Depression? I
don't think so. Yeah. I had a great conversation with Arthur Hayes about this, where what you're describing about their ability to print money. Well, there are certain puzzle pieces that fall into place or they start to break apart, and that gives them more or less of an ability to print the money. For instance, Lisa Cook, the fourth Fed governor, if Trump has 4 out of 7 of the Fed governors at his disposal, then he can start to take control of the Fed and print money at will. Lisa Cook is the fourth. And if she gets removed, like there's this mortgage crisis, whether or not she was, fraudulent and gets removed for cause, that would give Trump 4 out of 7 that essentially pledge allegiance to him and therefore would cut rates on his command. But I want to, and so generally printing money is going to help both gold and Bitcoin. You're very involved in both of these markets. I'm curious how you're thinking about the duality between the two. Where do you think the gold ratio to Bitcoin is headed from here? Got another one of your tweets up. Stocks up, gold way down, Bitcoin down. Bitcoin trades independently on any given day. Some days randomly with gold, some days randomly with stocks, an uncorrelated asset. Right now, these are both part of the debasement trade. Do you see one of these outperforming the other going forward?
I think over a long enough time frame, you can just zoom out on the Bitcoin to gold ratio, and it's nothing but up and to the right with a few turns up and down here and there. Now, if you look, it does look like Bitcoin has broken down against gold on the longer term chart, but let's be real. Bitcoin has probably a lot more room to run. And the more that gold runs, you have to assume that if there is a narrative that they're both part of the debasement trade, and there are people who are younger who now understand the debasement trade are not going to buy gold, they're probably going to buy Bitcoin. You would think that he would either outpace it or keep it up. But I mean, what's gold's market cap now?
30 trillion, 28 trillion maybe
dollars, right? So we're at less than a tenth, even with Bitcoin going up this high. Well, I mean, it's 25, right? So the ratio right now is 28. So
yeah,
it's 28.
Dude, to think about 10% move in a $30 trillion asset is incredible.
That's right. So imagine if Bitcoin just outpaces gold by 10% and they're both going up, right? You have a massive move for Bitcoin. So I think that over long enough time, Bitcoin will continue to outperform gold. And I actually think Bitcoin is more likely to go up regardless of what gold does, because I do not really view it as a correlated asset. And I'll have these arguments, and I'll have the argument with someone who thinks it's a risk asset and trades like NVIDIA. And the flip side, I'll have someone who argues that it's a risk-off asset and trades like gold. And you can't have it both ways. And that's what actually makes Bitcoin beautiful, is if you look at any investor portfolio, the holy grail is to have an idiosyncratic asset, something that has a chance of trading different than everything else in your portfolio that's uncorrelated, right? Even if it goes down when everything goes up, that's actually good for your portfolio because you have something that's different, right? And so Bitcoin really has, you can look at Sharpe ratios, but historically it has offered that. Its correlation over long time frames is extremely low to either asset, 0.06 or something to stocks. So I just really view it as one of the holy grails of a portfolio, even if it goes down.
Yeah. Yeah, uncorrelation is great. And for such a long time, we saw everything in crypto correlated. Things are starting to diverge. We're seeing large caps do quite well, alts not do as well. I want to switch gears here a little bit because we had some news that hit the wire this morning. I'm sure you saw yesterday, Coinbase acquired the up-only NFT, 25 million bucks. This was pretty insane to pay $3 million for per live stream, per podcast episode.
Yeah, we're in the wrong business, or doing the right business wrong, I should say.
And we kind of realized that this was part of a marketing campaign that Coinbase ran for 𝘗𝘗, which they announced today, an acquisition for 375 million. I'm curious, do you have an 𝘗𝘗 group? Have you used 𝘗𝘗? Generally, you were around in the ICO days. I remember back, 2017-ish. I remember following you. Now we've kind of revisited and revived the ICO phenomenon, but we've done it in a more KYC'd and professional way. Do you think there was plenty of grift that happened back then, Dent2Coin and the likes, right? Do you think there was positives that we can pull out, and now 𝘗𝘗 is in a position where it can provide some real value?
I definitely think there's positives that we can pull out if they've built something that's good plumbing for launching projects on a reputable platform. I think that that's obviously a positive, because Coinbase's reputation is likely to be behind anything that's launched on there. So when they inevitably go down 99.9%, it'll be Coinbase instead of a bunch of influencers getting roasted. And I've never used 𝘗𝘗. I got pretty heavily rinsed, both just for participating and actually monetarily in a lot of that ICO nonsense, especially in 2021, in 2020, that sort of iteration of it. And I deeply believed in a lot of the stuff, only to realize, after it all went down, that it was just all kind of correlated nonsense, and really dug into the tokenomics and understood that, we were all just buying a bunch of paper. If it changes that, I think that would be great. I think what they're really buying here, as you take a look at it, is very clear from the, as you said, 25 million for the podcast. Clearly they didn't pay 25 million for the podcast, right? It's just part of this deal, but a great, incredible marketing move to preempt this deal with that news. I think they're buying Kobe.
Yeah.
I don't know if he's worth $375 million or not, but a very powerful voice, obviously, in the industry. And so if you're getting a platform that is, by the way, I'm not discounting the value of the platform itself, but, a lot of people look at this and are like, they probably could have gotten it for 50 million or 100 million.
Yeah.
How did you arrive at the price of 375? I'm imagining that they paid a premium because they get exceptional marketing voice as well as a part of the deal, who will be, a cheerleader, and obviously who will be sort of foghorn, megahorn for talking about this constantly. I think that it's great if this helps eliminate some of that grift that you talked about, that there's another layer of research or due diligence that's done in some way because it's coming from Coinbase.
Yeah. Generally, we had VCs that are supposed to filter out some of that grift, but then the VCs started pushing the grift on us and profiting from it. So it wasn't PvP anymore, and the grift wasn't coming directly from the founders. Hopefully, by getting some combination of the two, the VCs plus crowdsourcing more of this funding, we do get more filters, better quality founders as the space matures.
I mean, at the end of the day, the concept is brilliant, right? Fundraising that's crowdsourced, that anyone can participate in, that doesn't have accredited investor laws and isn't necessarily focused on predatory VCs. It's great. Just as you said, it has to be used by the right founders in the right way, and it should be used for things that are actually built and real, and not just ideas and vaporware.
Yeah, great call. The next thing that I want to talk to you about is in this similar vein, the space maturing, moving towards a more professional nature. I mean, look, we're seeing that with the Fed Payments Innovation Conference today. We were live streaming it. I saw it. You're live streaming it as well. It's very, very cool to see Fed literally hosting a crypto conference. I mean, who would have thought?
It's bananas.
Yeah, it's awesome. And we're seeing a lot of RWA conversations, private credit, stable coins, all this great stuff. Two Goliaths when it comes to the RWA world but also the DeFi world, and really two companies that are crossing the chasm here, partnered up today, Maple and Aave. I'm curious, what do you think about this institutional DeFi wave and RWAs, and how these two worlds of Wall Street and DeFi are converging?
I'm pretty friendly with Sid Powell, the founder of Maple. We had a conversation probably last a month or 2 months ago, so I wasn't necessarily on top of this move, but I think that what they're doing is incredible and is a pretty good window into this space, right? That you're going to have a lot of institutions that in various ways are holding a lot of these assets or gathering them and are going to want to put them to work, right? And the best way for them to put them to work right now, especially since we're still in the first inning of actual bank custody and yield products coming from TradFi, right? I mean, we know that State Street and Bank of New York Mellon and Citigroup, they're all coming, right? The biggest custodians of the world. And once they come and they're custodying these assets, they're going to find ways to put them to work. But right now, the best way to do that is in DeFi. And for all of the shit that we've gotten in the crypto industry for things breaking and collapses and scams, DeFi smart contracts have hummed along exceptionally well through every cycle of this market, right? I mean, your collateral goes in, you're over collateralized, you get a margin call, you get liquidated in an orderly manner for collateral that's already there. You might be broken, but the system keeps humming. And so I think that Aave has proven to be a great player in the industry, extremely stable and reliable. And so I think that companies like Maple are going to offer a bridge between those institutions that are holding the money and are looking for yield or looking for loans, and they're going to be able to put these things to work in Aave. So I think it's really this is very early innings of this, but we will see TradFi heavily using DeFi for yields.
I totally agree. I think even once the custodians that you mentioned, these mega Wall Street custodian asset managers, even once they do get involved, they're going to go where the existing pool of liquidity is. And right now that is on Aave, $25 billion, if not more, I think, on Aave now, puts them, I think, in the top 50 banks worldwide. If I remember correctly, they posted something the other day, and they're just rising through the ranks when it comes to the size of bank that they are based on their assets, TVL, and their assets in the platform. I think one thing that was interesting about this partnership in particular, if we start from the bottom of this thread, Maple says to start, Syrup USDT will be listed on Aave's Plasma market. Maple says the deepest liquidity layer and the largest on-chain manager are now aligned. What do you think about Plasma, and what do you think about Maple choosing to deploy this partnership on Plasma originally?
To be quite honest, I wish I could give you a better answer, but I haven't dug deep enough in it to speak about it intelligently, and I don't want to make something up.
No problem. No problem.
I've obviously heard, I'm aware of it, but I can't really get into the nuance of why they would have chosen that specifically versus any other platform with Aave. I can just say that if that's where they chose to go, there's definitely a good reason, because these guys all know what they're doing.
Yeah, I totally agree. I think Aave is one of the pure class acts out there. I believe the Aave token rose about 10% on the news. This was before the market started ripping just a few hours ago, and could be up even more now. Maple says the network of allocators and borrowers represents billions in deployable capital, seeking stable, scalable returns and deep liquidity. Through this partnership, Aave unlocks access to that demand and reinforces its position as the leading lending protocol in DeFi. This is just two mega Goliaths now partnering up and doing the stewardship and the pioneering into Wall Street to bring these guys on chain, which is really, really cool to see.
Yeah, I think that we're going to see a lot more of this.
Yeah. And so how do you think Wall Street and institutional finance is going to make their assets go to work? Just something that you mentioned earlier, once these guys get assets in their custody, they're going to put them to work and program them so that they can get some yield, and they can make a spread on the custody of these assets. Previously this has been done kind of off chain, behind the scenes, lending out. MicroStrategy does this off chain. They get some Bitcoin yield. Do you think they're going to deploy some or all of the assets that they have under custody are we going to see it like the Ethereum ETFs and DATs? They're going to just stake it, or what? How do you think they're going to deploy these assets?
I think it's going to depend. I think custodians have a whole other level of laws and regulations that they need to follow by, and I don't think they can YOLO into Aave with other people's assets that they're supposed to be keeping custodied. So I doubt that they'll be able to put them to work in that way. I would say that when you look at the huge custodians, it'll probably be in line with whatever they've done with traditional assets. I think the story there is that Bitcoin and crypto assets, at least the ones at the top, will be treated just like everything else in someone's portfolio and by these custodians. And before SAB 121 was recently overturned after Gensler left office, they weren't even allowed to custody assets without having cash on the other side of the balance sheet to offset it. So it was literally impossible for them to do it. And interestingly, as they tried to kill the industry by doing things like that, they actually handed Coinbase the custody of every single ETF, because those ETF issuers like BlackRock couldn't go to their trusted custodians because of this rule. So it actually ended up shooting them in the foot and giving crypto native custodians like Coinbase the bulk of the business when it came to ETFs. Obviously, the banks freaked out. They overturned SAB 121, and now they can custody these assets like anything else. But imagine, I mean, what that means for people to understand. If BNY Mellon or State Street wanted to custody $100 billion in Bitcoin, at that time, they would have had to raise $100 billion in cash to offset it on the other side of the balance sheet. And nobody would be insane if they even could to do something like that. So they were basically liabilities, right? And so now they're assets like anything else. And how does that, I guess, I think the more interesting question is, how does that trickle down to the consumer? Like how they'll put it to work, I don't know. I think that institutions that don't have that same custodial laws will just, use normal lending and borrowing, and may even go into DeFi and all of these things. But what really matters is for like a boomer or some wealthy person who has a Charles Schwab or a JP Morgan account. And now that we know that on Schwab and JP Morgan and Morgan Stanley, very soon you'll be able to hold these assets spot, Bitcoin and ETH, you'll be able to trade them. And then they'll just be treated as a part of your portfolio that you can take a security loan against. That's the real unlock here, because wealthy people don't sell things, they take loans against them, and those loans are at much lower yields than you see on the tape for the 10-year treasuries. I mean, I think on Robinhood, even right now, you can use Bitcoin and Ethereum next to your stocks and get a 4 to 5% loan. When you can just have Bitcoin bulked in with all of the other assets on your investing platform and take a loan against it en masse, that's where things get really, really interesting, because A, everybody's going to want to do it, and B, there's going to be a hell of a lot less selling pressure.
Right.
Right now, if you want to really capitalize on your Bitcoin, you either have to take a loan in, DeFi or one of these platforms, but there's still, 10, 12, 9, really high, pretty much interest rates. Imagine when that's thrown into your portfolio and you're getting 4 or 5% against it. Everybody's going to do that. Nobody's going to be selling.
Yep. And the administration has already outlined proposals to include crypto assets on a customer's balance sheet when they go to get a mortgage. And so you're absolutely right. If someone were to look at buying a house and they have a significant portion of their net worth in crypto, they would have to sell it in order to go finance the house. I think now also
not even to finance, to qualify, and you might not end up getting the house even now that you've sold your assets. So yeah, it's wild.
Yep. And I think this is also, it speaks to the money printer. And this goes back to the debasement trade with gold and Bitcoin, all the things that we're talking about, which is really one of the drivers of this movement in general, is how money is created. And we're seeing money be created at multiple levels of the system. We see it obviously when there's appropriations in the White House and Congress, they print money to finance some of these social programs. But there's also this concept of the money multiplier as regional and commercial banks print loans. These guys are extending credit, and that is how money is created. Oh, Scott, did we lose you? Oh, I think we're okay. We're still here.
I hope I'm here.
Yeah.
I'm enjoying listening to you. I don't know if you can see me, but I can definitely hear everything.
I can see you now. And so this is all an extension of credit. As we can create loans and we use more of these assets as collateral, we can use this money multiplier to the effect of extending credit in the ecosystem. And this is generally going to be quite friendly to asset prices. Another point that I want to bring to you, is something that Chris Waller, a Federal Reserve governor, just said at this conference this morning, which is that they're starting to close the gap between the stablecoin issuers and the Fed. He said that the Federal Reserve is now looking into payment accounts that would grant crypto and fintech companies access to Fed payment rails. I looked a little bit more into this. It would mean that stablecoin issuers could hold cash at the Fed, tether US, effectively be a bank, exactly, and no longer have to go through an intermediary bank that has a Title 8 and has an account at the Fed in order to acquire these treasuries. Again, disintermediate these guys that are just rent seeking somewhere in the middle. Previously, they were providing a service, but now we have the technology where we can just provide that service to everybody. And we can start to bring these guys closer into the banking system and ultimately make this capital a lot more efficient and give a lot more access to stablecoin issuers. I'm just generally curious about how you're thinking about the integration of Wall Street and crypto at the largest scale. As we bring crypto companies closer and closer to the money printer itself, how do you think stablecoin companies are going to continue to grow and distribute the dollar over the world and acquire treasuries and distribute this over the world?
The irony is so incredibly thick, isn't it? That the whole point of crypto, of Bitcoin, was as a cash to cash, a peer-to-peer cash that was going to disintermediate third parties, and we are going to eliminate the toll collectors and institutions in the middle. And now the institutions we are trying to eliminate are trying to use this to eliminate other institutions in the middle. It's just crazy to watch. And I think the other irony is that dollarized crypto, aka stable coins, crypto dollars, which Bitcoin was created as a hedge against fiat debasement, that arguably the best use case for the technology has been hyper dollarization, basically to make dollars faster and cheaper to move and easier to access all over the world. So I think that it's worth noting all that irony. That said, like, the only way Bitcoin and crypto get to the top is to power through, and that means co-opting or taking over all of the systems, right? And this, at the very end of the day, stablecoins are just a better way to do business for all of them, right? So it's either you're going to be Blockbuster and Kodak and deny that there's going to be, digital cameras and streaming, or you're going to have to find a way to slow things down enough that you can actually capture some of the value or integrate this technology yourselves. And I think that that's what's happening here. I mean, my friend 𝘗𝘓𝗦𝘡 has to be scratching her head and screaming over at Custodia Bank, where she got rejected for a Fed master account multiple times and has been suing the Fed for exactly these things. And now you just see them flippantly kind of mentioning it in a conference or, in a round table. But this is the future. Like, stable coins are faster, they're cheaper, you don't need a third party, you don't need permission, and they spread dollars all over the world. So what scares me here slightly, obviously, is this is just inching ever so close to a central bank digital
And we
currency,
know that's what Europe is.
which we know would give them ultimate control of the money supply. They've
Yeah.
outright said that,
And we know
not what they
Europe
want,
is
but this
intentionally
definitely a
going in that
step
direction. They've openly spoken about how central bank digital currencies are great for transparency.
Yes.
Right? And consumer protection. Like, anytime the government starts talking about protecting us for our own good, that's when the libertarian in me just wants to just explode out.
Yeah.
Man, Scott, this has been a fantastic conversation. Only a couple of minutes left. Would love to get some closing thoughts on your end. We talked about so much today. I'm just curious, maybe you can just pull out some takeaways for us. What are the things that are sticking out to you? What do you think are going to be the most important things to keep track of as we, go into Q4 and the end of the year?
Yeah. So I think that it's very important, as much as I hate to cheer for the government because I'm not, but I think that Elizabeth Warren being head of the Senate, that's exactly who she would be in the anti-crypto army.
Yeah.
All this every day. I try to figure out what's signal and what's noise. It's very tough, but I think that those are the things that are pretty important right now.
Love it. Scott, thanks so much, man. Tons of material here. I think this is one that everyone can dig through and they can go back into and really learn a lot. We're going to have clips rolling over the next couple days
Awesome.
because we covered so much. So we'll send those your way. And absolute pleasure. Would love to have you on again soon.
Anytime. Thanks so much.
Cheers, Scott. See you next time.
You too.
Beauty. Man, that was great. So much fun. I know we've got to let Scott go, but we're going to keep things rolling on our end. Man, I think there's also this crypto conference at the Fed is, it's just getting started too. There is so much bullishness happening all across the board. Ultimately, bringing these stablecoin issuers, bringing stablecoin companies, I think this is going to pave the way for crypto companies in general to become more entrenched in Wall Street, in the Fed. All of these things are happening right before our eyes, and it's happening at a grand scale when it comes to the finance element of things. But then it's also happening at a micro scale when it comes to the technology of things. We're iterating and innovating one piece of the stack at a time, and it's incredible to see. Our next guest, co-founder of 𝘗𝘪𝘴, Jason, is coming on now. We're gonna bring him up, and here he is. Jason, what's going on, brother? How you doing?
How you doing, man?
Good, man. Good. Just we were live streaming this Fed crypto conference, which was pretty incredible to see. I think Cathie Wood is going to be up in just a few, and they're just talking about how we're bringing these two worlds together. Where, I mean, just a year ago, they were tackling our industry. They were bringing it down with every shred of their being, and things are just very, very different now. Have you guys seen this in practice? Like, were you building in the Gensler era? Did you kind of have to adapt your go-to-market strategy for one way or the other to kind of circumvent things or avoid getting in trouble? And now it's kind of blue skies, free and clear.
Absolutely. Did we? We actually founded 𝘗𝘪𝘴 and raised our initial kind of pre-seed round all the way back in 2022, in the middle of 2022. So we went straight through the Gensler era. And as a result, kind of in the middle of 2023, right, we actually left crypto behind as a go-to-market wedge and as a capital markets wedge, not permanently, but it was clearly not, it was a non-starter for a US-based company to be really experimenting with DeFi and with tokens as kind of a core part of the product. And so we actually built just a very traditional electrification marketplace for the residential market for a while. And as the election started to shape up and we started to see pro-crypto policies on the kind of agenda for the election, it really gave us the comfort to go back and build what our initial vision was. So we've been through it, and I mean it's wonderful to be in the position we're in today.
Absolutely. It's well said, and this is just the general sentiment that we're hearing, from builders. Sometimes they were pushed off offshores; they went to other countries. Sometimes they abandoned crypto altogether, and now we're seeing this resurgence. But Jason, man, it's your first time on the show. It's a pleasure to have you. I'd love to get a little bit of an intro on yourself, and also you mentioned what the overall vision for 𝘗𝘪𝘴 is. Please, introduce 𝘗𝘪𝘴 to our audience and give us a sense of what that overall vision is.
Absolutely. Well, it's really great to be here to introduce 𝘗𝘪𝘴. 𝘗𝘪𝘴 at its core is really a new kind of energy network that connects people, capital markets, and power companies in the grid into one unified network. What that means in practice is 𝘗𝘪𝘴 really offers energy that's cheaper and more affordable and more reliable than what their utility offers to homeowners through an energy as a service product. Homeowners can subscribe to 𝘗𝘪𝘴 and at no cost get solar and storage installed on their roof and pay 𝘗𝘪𝘴 rather than pay their traditional utility bill. Capital markets get access to electricity as a brand new asset class for the first time through our on-chain pools, where we're offering the ability to participate directly in this new kind of unique infrastructure revenue stream. And power companies can tap into this network as an aggregated new flexible resource to support energy grids as energy grids are increasingly strained from new demands. And all of that is kind of bundled together into one core product that reduces costs for participants and increases the opportunity of the kind of global network. So really our North Star and our mission is to scale energy capacity for power grids to meet all the coming demand from AI, from robotics, from reshoring of industrial capacity, while also ensuring that homeowners and business owners can get access to more affordable and reliable power than they traditionally can.
The headline that we have on here is Jason on energy capital markets, which if internet capital markets took the world by storm, just a few months ago when Solana was pioneering that, I think energy capital markets are another meta here that is just getting tapped. I was just listening to All In today. I'm on my way to the studio. These guys were talking about how Wisconsin, Indiana, these guys have data centers that are coming to their states, and they're actually getting shut down at like the city level because people don't want a few things. They don't want a rise in their electricity. They don't want the rise in their water, and they don't want the noise pollution. And they sort of started talking about how these issues can be circumvented. I'm just curious, when it comes to these energy capital markets, we're seeing data centers, we're seeing all of these things, we're seeing AI just starve our power grid, right? Did you also kind of, before you started building Daylight, did you see this trend, how energy was becoming just this really, really scarce commodity, and you saw energy capital markets as a way of kind of transitioning to more of an abundant era of energy?
Absolutely.
Yeah, maybe you could just expand upon that. Like, what were some of the early signals that you saw that kind of lit that light bulb in your head and said, "Oh, we've got to go build this"?
Absolutely. I mean, that was very clearly one of like the big North Stars for kind of the genesis of Daylight. My background is in energy finance. So started my career in energy and power investment banking, moved into private equity, investing in energy infrastructure. And what was very apparent all the way back in even 2022 for us is that for the last 2 decades, most people don't know this, but electricity demand growth in the US has been totally flat. Any growth in electricity demand has been offset by efficiency gains for the most part. And so what we have is an entire generation of grid operators, utility executives that have never in their career experienced demand for power rising. And all of a sudden, we're moving to a world with the rise of AI, with the rise of compute, with the rise of robotics, reshoring of industrial capacity and kind of deglobalization, electric vehicles and autonomous vehicle fleets. All these things significantly, number one, change the profile of energy consumption, and number two, increase it significantly, right? We're expecting peak demand of electricity to more than double over the next 10 years now. And so we need to find new solutions in order to meet all this coming energy demand. The fact is, these AI data centers just won't come if the power isn't available for them. And we will lose out in this next version, in this next super cycle of the internet, of capital markets, of capitalism, if we can't provide the most basic commodity in order to build it, which is power. And so what Daylight is here to do is be a new kind of generative resource for the grid to scale distributed energy to, number one, meet that energy demand, because the more energy capacity, generation, storage we put on grids, the more it frees up energy capacity to go to new sources like AI data centers. But what uniquely Daylight does compared to a centralized energy developer is it does that while also lowering the cost for homeowners, for business owners, and gives them something that's more affordable and frankly a better product because it's more reliable and inherently protected from any kind of blackouts or storms. And so that's kind of the unique position that Daylight finds itself in.
Awesome. And I think you're hitting on what the capacity for this is, what the possibilities of this coming to market is, and what it does for electricity, what it can do for homeowners, what it can do for data centers, anyone, any consumer of electricity, which is effectively everyone. But how does it actually work? Maybe you could describe the mechanics, right? You're consuming electricity, but you're also getting rewarded for it. There's obviously a crypto tokenized element to it. Can you just kind of walk us through the game theory and the mechanism design?
Absolutely. At the high level for the homeowner, right? Really, Daylight's product is more reliable and affordable power. So the homeowner subscribes to Daylight, and when they subscribe to Daylight, solar gets installed on their roof, an oversized battery gets installed on the outside of the home, and they start consuming electricity from the system that's sited on their local home. So instead of having to pay cash, $25,000, $30,000 for the system, or take out a loan, they simply outsource it to Daylight, and they just get the benefit of the hardware, which is the power itself and the cheaper, more affordable and reliable power. At the same time, as we scale this amount of nodes,
no cost to the homeowner.
no upfront cost, right?
Upfront
You're buying the power from the system rather than buying the hardware. And
So you guys are innovating and replacing whoever their current power provider is.
Exactly. The Daylight becomes the main supplier of electricity through the hardware that's installed on the home.
Got it.
From there, as you expand the amount of these little nodes in a network, through software, you can actually aggregate the solar and batteries together. and allow power traders, utility companies, other grid operators to tap directly into this aggregated power when demand on the grid is super strained. The grid itself is not strained very often, but when it is, it needs power and it needs it now. And we have a resource that can supply it in a large quantity across this entire network of homes and generate additional revenues from doing so. So instead of purely just generating all your revenues from selling a product to the off-taker, the network can generate something that's even more meaningful by taking its aggregated capacity and selling it to power grids. And the last component, right, is how do you finance all this? And that's what we plan to do with DeFi and stablecoin markets, where we want to launch on-chain yield products that make electricity investable globally for the first time. Today, if you want exposure to electricity and you're not Blackstone or BlackRock and you're buying power plants at large scale, you can buy utility wrappers, right? You can buy utility stocks, you can buy independent power producer stocks. You can't really get exposure to the underlying asset class itself. And what Daylight is starting to offer is a tokenized version of electricity to allow investors to participate in its financing and Daylight to scale the physical infrastructure on its network. So that's kind of the core three-sided marketplace of Daylight between capital markets, homeowners, and the grid itself, and really how it all works.
Yeah.
We plan to, additionally, if you look at the kind of history of DePIN in crypto, there's been a lot of interesting use cases in like scaling supply, maybe less so on generating a ton of demand up to this point. But we've seen incredibly exciting proof points from Helium, HiveMapper, Filecoin, Bitcoin, Ethereum. When you launch a token, you decentralize a network and you give ownership to a community, you get these really interesting outcomes on the supply side. And so Daylight plans to do the same thing with actually decentralizing our network, turning it into what is almost a form of a electricity cooperative and distributing ownership to participants who are going and scaling that network. And we think that is the way that we could achieve significant scale kind of beyond the traditional sales model that's been in the solar space for a long time.
It's just fascinating because it's not just another financial engineering that, Ponzi meme coin. Like there's actual real productivity that is being done at the electricity and the bare power level to help people, like improve people's lives. I remember hearing about in Texas, there was a power outage. It was due to the grid.
Yep.
The grid was significantly strained. You probably know a lot more about this than I do. Could you just explain why the grid was so strained in Texas and how Daylight could potentially solve an issue like that?
Yeah, if you think, and this isn't specific to Texas, this is California, this is the Northeast, this is really everywhere. We've seen these massive grid events that either almost lead to blackouts or do lead to blackouts. Really, the nature of it is power grids have to be sized to peak demand, not to average demand. The reason for that is supply and demand of electricity always have to be in balance. And if they become imbalanced, the grid itself starts to fail. It'll destroy equipment, it becomes dangerous. And so grid operators actually shut the grid off whenever supply and demand become extremely imbalanced. So when you think about the rise from demand demands, that impacts what average demand is. That happen in a matter of hours. When operators see peak demand rise above what the forecast is, they find new ways to supply in the system or to reduce demand in the system in order to ensure the grid balanced. And so, just like Daylight offers basically a real-time resource to power grids, an emergency reserve resource to power grids, increase supply or decrease demand to ensure that they keep the system balanced in these periods of really, really peak strain and maybe above what their forecast was. Nuclear plants can't ramp up quickly. That's a big downside of nuclear. Coal plants, natural gas plants can ramp up a bit faster, but batteries and demand response are really this resource. And Daylight's entire network of batteries and demand response can provide that support to power grids, help balance the system before it gets to a place of crisis.
Dude, I love it. I'm curious, like, where are you guys at in your stage of development now? How can people get involved? Like, it is the only way to get involved just from buying a solar panel and installing this hardware and becoming a part of the network that way? Can people buy the token without having hardware? And kind of grab the three-sided marketplace here, but can you just expand on some of the network participants are?
The host of the equipment. So the subscriber who subscribes like hosts the infrastructure and becomes a new node in them. That's available right now in 2 states, Illinois, Massachusetts, but we're expanding that across the US pretty rapidly. And so that's like the basic participate is host infrastructure, more power, reliable power, and get rewarded for helping scale lights network. Participate yet, but and will be in DeFi markets, participating in financing of distributed equipment across the network. This looks to what AI is doing on the GPU side. Your team, excellent work in kind of designing mechanisms on stablecoins to find some GPUs collapse. Product will look very similar to that for electricity. And then the third way, it's really to be kind of a community supporter and it's deepen style, if you will, a operator on Daylight. So going around educating the on Daylight, people into the system, referring people into the system, explore how it can make their house more resilient, they can make power bill cheaper, and how they can become in the network. So we'll actually be putting out a lot of tools, education material, and resources for people who don't their own Daylight, but want to get involved in the network, get rewarded for the network, to go to their local community and provide their families, their scale the network from bottoms up. Very traditional deep-in way.
Man. And can you help me understand how energy transfer works? Like when you have a battery attached to a house and your so I'm getting this wrong. Actually, your panels, you're capturing energy from the sun, you're turning that into solar and electricity. And you're storing that in the battery. That's attached to the home. When it comes to transferring the energy from one battery attached to one home to another home with another battery somewhere in a different county, because over there the drain, how does energy make that transfer? Like how does man, okay. Oh, this is fascinating. And like these are conversations that we don't have very often. A lot of times it's, financialized kind of tokenomics here. You guys are building hardware, and I think there's only a select few projects that are building these deep in infrastructure projects that ultimately I'm curious actually how the network effects could expand as you guys grow. Like you said you're starting in Massachusetts, maybe one other state. Why did you choose to start there? And then as you start to expand regionally in the US, maybe globally, what are some of the network
where
effects
we
that take
kind of
hold?
prioritize markets is based on where the
how do
market
you
is telling
expect
us
this
to
network
prioritize this
to
market.
grow and
So
expand?
think very high power prices compared to a national average, and where the market itself is deregulated enough for us to participate. So traditional power markets, like back in the day, were served by a vertically integrated monopoly utility. In kind of the early 2000s, the majority of power markets were deregulated, where the generation of electricity is competitive. Anyone can really participate in this market to generate electricity. And that's an attractive marketplace for us to monetize on the grid services side. So we look for the intersection of high power prices where we can provide a real benefit to consumers and markets that have very easy access for us to participate in and generate additional revenues. So that's why we picked the Northeast. We think there's a ton of strain, both from data centers and other reasons why there's kind of very high power prices in that market. They have attractive deregulated markets for us to participate in. And then we'll be expanding outward from there to other markets as they come online. But the unique thing I think about decentralized networks is that they will at some point begin to just scale on their own. And as they scale on their own, that aggregated asset base allows us to do other interesting things that you wouldn't be able to do if that like upfront before that asset base existed. For example, there's an interesting thought experiment of what if data centers developers themselves could contract with a decentralized network to basically have a bilateral virtual power plant where they say, hey, I need, an additional 10 megawatts of capacity. Can I pay this network directly to dispatch when I need it to dispatch, when the peak demand on the grid is highest, in order to ensure that I can be interconnected in and the utility will accept my interconnection process. So there's interesting things like that emerge as your asset base starts to scale and you have a physical resource that you can build markets around.
And you just reiterate what the token design is? You're using the token to facilitate transactions of energy.
No, so you'll pay with dollars that actually become stable coins on chain, but no, there's no kind of user needing to price their services in some crazy volatile token.
Okay.
It really is very much a economic alignment, deep in style incentive tool for scaling the network and rewarding people for joining the network and reducing origination costs and customer acquisition costs. It's used for, of course, governance and shepherding the network, and we'll have like some interesting announcements on how the network design is actually structured legally to make that pretty enforceable. And then the last is economic rights on the protocol and protocol fees from financing these assets, for delivering them into the ground, and then claiming fees on top of the assets themselves. So this is very much a kind of deep inner DeFi style network token distributed to its participants to decentralize ownership and decentralize incentives and decentralized capital formation.
Got it. So it's
contribution
more
and stake,
of a
exactly.
means of measuring stake in the network, the stakeholder, and a utility token. Okay. Okay. Cool. And how does the cost stack up to current energy providers? Like you said, no upfront cost. The equipment, the installation, all that is taken care of. But in Florida, I have FP&L.
Yeah,
right?
so it certainly ranges, but our ideal
how
target that we think is a
how
sweet
would
spot is
the
20 to 30%
cost
savings
on, like, a
immediately on
monthly
the
basis
utility
compare?
bill with backup power built in. So there's immediate savings to the customer. They get access to an oversized battery to protect them from any kind of power outage, and they get what is really a better service for a better price. So 20 to 30% is kind of our ideal target, but it can fluctuate from there.
Mhm. Awesome. What were some of the learnings that you took from the other deep projects like Helium and these guys that have set up this infra? You even mentioned Bitcoin and ETH, as ETH obviously started proof of work, and Bitcoin still is. What were some of the learnings? Do you think these guys did it the right way, and it's just a matter of these are some guys that have stuck around? They survived.
I think this is like, it's also kind of
seen
back to
some
like
success. When it comes to the network
Chris
design
Dixon,
driving the
Read
network,
Write Own,
what
like
were
your
some tools
margin
that
is
you
my
figured out that you guys
opportunity.
didn't employ?
Decentralizing a network, especially in a regulatory regime like we have today, as crypto is becoming really professionalized and institutionalized in the US, it is like taking the Bezosian, your margin is my opportunity, and applying it even further, which is saying, I'm taking all of my economic value and distributing it to my users. And if you aren't doing the same thing, you won't be able to compete against me. And that's something that I think Helium did in a really interesting way, which is build this huge groundswell, this huge community, 200,000 people in Discord nerding out on radios and wireless signals. That's something no other company that has attempted to build a new wireless infrastructure network that's not AT&T, that's not Verizon, has ever accomplished or even come close to. And so what we see is the opportunity to use tokens, to your point, to reward contribution, to reward ownership, to build a cult brand around energy, around the super cycle that we're attempting to build and scale, and then to outcompete other networks that are attempting to capture all of those economics back to themselves and extract all those economics back to themselves. We don't think anyone would be able to compete with us when rewards are actually rewarding those that are building the network rather than the company that might be trying to string it all together.
This is fascinating. I mean, do you anticipate more of the companies that are currently providing power, are any of them thinking like this? I have a feeling, some of these guys are launching solar panels, they're doing installations, and more of them, and then there's a subset of those guys are installing these batteries as a means of capturing, storing energy. Maybe even a subset of them are thinking about the transferability. But do you anticipate more companies going this direction?
I think there will be. And there are quite a few
kind of
startups that
layering on this
are
stack
interesting
and then building a more
and are chasing this
decentralized network of
opportunity. I
energy?
think we all have our different styles. 𝘬𝘓𝘴 is certainly the only one that's attempting to build this in a community-first way, and is also attempting to tap into internet capital markets for what is basically infinite scale to actually develop the infrastructure required. But there are quite a few different companies who are starting to think about this today. What we've seen is kind of the legacy solar industry has really started to collapse on itself because it was propped up on really predatory and inefficient sales mechanics, really inefficient predatory financing mechanics, and over-reliance on tax credits that are now phasing out. And so what we're seeing is really the old guard is kind of collapsing. What that opens up is kind of a early 2010s fintech style opportunity in a totally different market where all these fintechs emerged after the 2008 financial crisis to provide a better product at a better price to people. That's the similar opportunity here in energy and distributed energy today, as the kind of old guard starts to falter, and these new companies are doing things in a network first way, developing batteries, deploying them on the grid, and using this kind of total network to support the grid rather than just purely being a high ticket sales business.
Got it. Jason, it's been a pleasure talking to you, man. Love just to get some closing thoughts. Like, where what experience been like? Where you guys
Job's
are at
certainly
now?
not finished, and our total focus is on scaling megawatts under management. Eventually, our goal, we like to say terawatts in all of our posts, because our goal is to build terawatts of new energy capacity and do it in a way that is community first and rewards people for doing so. So what you'll see from us is deployment of energy subscriptions at scale in our initial markets, expansion outward into new markets, and then opening up participation in the financing stack for these types of infrastructure assets coming in the next quarter, which we think will be incredibly exciting for DeFi, opening up a new uncorrelated yield class, getting exposure to the energy super cycle led by AI and robotics, and really providing globally like the first access to that opportunity for the first time. So anybody listening should follow us on Twitter at 𝘬𝘓𝑒nergy_. We're working on a better handle, but for now there is an underscore at the end. Make sure you don't miss it, and follow along on all the opportunities to get involved and participate across all components of the stack.
Yeah, well, you got a customer in me whenever you guys do launch in Florida. We got plenty of sun, so I can be a contributor to the network. And yeah, I mean, it's been great to watch your rise up until now. Just getting started.
Amazing. Thanks so much for having me.
We'd
This is
love
great.
to host you again soon, man. And best of luck on continuing the build. Yeah, same here. Cheers, man. See you next time. Very, very cool. Awesome. We're gonna keep things moving. I love these kind of alternate conversations where we have so many conversations about DATs, real world assets, stablecoins, all these things. Yeah, it is a stablecoin super cycle, but it's also an energy super cycle, as you guys heard from the last guest. So appreciate Jason for coming out. Next guest, we're going to keep things moving here, is 𝘗𝘓𝘏 from Synthetix. These guys just launched their trading competition last night. Very, very cool. I believe it is live now. Yeah, we're going to kick it over to 𝘗𝘓𝘏. I think we're just going to take a break, and we will hear from him and all the exciting Leo, is everything good on your end? Okay. Beautiful. Leo, is everything good on All right, I think we're already rolling, so we'll just go ahead and get started. All right, 3, 2, 1. We got 𝘗𝘯𝘵𝗦𝘭, the DeFi legend, on the show today. What is going on, Kane? Welcome to the show.
Hey, thanks for having me back.
Absolutely, man. Well, it's exciting times. Regardless of what's going on in the market, there's all kinds of action left and right. Synthetix is just, I'm not going to say coming out of nowhere, but an absolute comeback arc for Synthetix. You guys have a trading competition going live here very soon with, I mean, none other than some of the best traders, or at the very least the best personalities on CT. And so I'm pretty stoked. We're going to talk about it. We're going to get into maybe some predictions or just general takes on what we think is going to happen during this trading competition. But before we do, man, maybe I know people are, they're aware of you, they're familiar with you, and they're familiar with Synthetix from the OG days. Most of our audience comes from that DeFi summer, that OG timeframe. Could you just catch people up on, how it's been going? What is the latest happening over at Synthetix in the last few months?
Yeah, so Synthetix, like 2022, I stepped back for a while, almost a year, and then I came back in 2023, and they had just launched Perps v3, and they were really excited about it. They're like, we solved all the problems while you were gone. We did this amazing job. It's so good. It's gonna solve world hunger, sort of thing. And so I was like, all right, I'm gonna just let them cook. I'm not gonna come in and start, messing with things. But I had this thesis that the biggest impediment to adoption for, Perps and other DeFi platforms was the fact that the UX was still not there. And it was still really hard to get, money onto L2s and all of the stuff that we kind of has become very well understood in the last 2 years. But back then, I think there was still a view that people would learn to come on chain and it would all be fine. And so I launched Infinix. The goal of Infinix was to build better DeFi front ends, to build a thing that would make it easy to use DeFi the way that it's easy to use a centralized exchange. And the initial idea was integrate Synthetix, and then it turned out that Synthetix v3 implementation was not amazing for reasons. Traders didn't love it. And so it was probably about a year of running that before I think everyone kind of capitulated and realized this is not the solution. And so then Synthetix went back to the drawing board, and in the interim, Infinix kept building. And now we've kind of come full circle because Infinix has deployed a Perps interface, which, in my humble opinion, is the best Perps interface that's powered by Hyperliquid that we have in the space. You can go from desktop to mobile. It uses passkeys. It's genuinely amazing. It's a really good interface. And we're about to finally integrate this new version of Synthetix Perps on mainnet. But it's taken about a year to build that Perps, exchange on mainnet. And so we're in this kind of weird, full circle moment where, Infinix went off and did its own thing, Synthetix, and then they've kind of come back together. So it's pretty exciting. It feels like it's all coming together.
Yeah, and now these paths have converged, and there's kind of this third prong to this as well, which is the general market and sentiment perception around Perps. It's this was an innovation. It was a crypto primitive that came about, and there was decentralized and centralized offerings of it. Synthetix was one of the earliest decentralized offerings of it. But it's really the market, Infinix, and Synthetix have all converged to this one inflection point where we find ourselves today. Was it that you guys needed to get something right and there was things that you just didn't quite have in the arsenal at the time? Or do you think it was just a matter of the market catching up and kind of realizing that this is one of the best mechanisms to trade?
I think it was, Hyperliquid proving that you could build DEX that could compete with centralized exchanges. You just have to make the right trade-offs. And, classic Synthetix made very aggressive trade-offs around decentralization. Basically, taking a hard line on any elements of centralization. I've joked about the fact that DAI was too centralized for Synthetix for a long period of time. And I think that the experience with V3, the previous version of Perps, where it was purely decentralized, there were all these intricate mechanisms to keep, funding rates in line. And traders just said this is not, you're optimizing the wrong direction, basically, right? Like what we want is a smooth trading experience, and what you've given us is something that is limited by the fact that it's so decentralized. And so I think with V4, we made a decision to kind of remove all of those hardline requirements. You know, obviously we still want a DEX, we still want it to be non-custodial. You know, this is one of the reasons, and this is kind of part of the strategy, coming back to Ethereum mainnet was one of those trade-offs to say, okay, the margin engine, the collateral will be on mainnet. You don't even need to bridge. We can access all the stable coins, all the wrapped ETH, all of the, you know, CBBTC, all of these collateral assets that are sitting on mainnet that do not want to bridge off onto an L2 or somewhere else. We can access all of those, but then we'll build some off-chain infrastructure as well to make sure that the exchange is as performant as possible. And so it's this kind of barbell strategy of like, go, you know, maximally secure on Ethereum mainnet with no trade-offs, and then on the matching engine, you know, make the trade-offs in terms of performance and latency.
Got it. And it was, and back in DeFi summer, back in the 2020, 2021 days, even that off-chain matching engine part, even though it doesn't house the collateral itself, it was still like a hard line decentralization.
Absolutely not. Like no chance. Like it would be like, get the fuck out of here. Like no chance when no one's touching this. And, you know, I think that, the experience with Hyperliquid in seeing, again, they made some trade-offs in terms of centralization. The validator set is much more centralized. And at the end of the day, for most traders, you know, they will weigh up all of the different components. That's their job, is weighing up risk, right? And they're like, okay, I understand this risk and this risk and this risk. There's a bit of counterparty risk, there's some bridging risk, there's a few things, but you're giving me a much better exchange that is really performant and, you know, has a decent amount of leverage and has a bunch of different markets and, you know, has like deep liquidity. And so I'll make that trade-off.
Yeah.
And so we said, okay, well, let's open up the design space and really like rethink what are the trade-offs that traders are willing to make and, you know, optimize for the best exchange, not necessarily the most decentralized exchange on day one.
Right. I think even though you guys have made those corrections and you've optimized now, you've shifted the optimization into this direction that is more in line with the market, people are still going to be skeptical of the Ethereum centric nature of this, because now there's sort of this, you know, if you want something performant, you want something purpose built, you go off of Ethereum.
I think, you know what, it's the best cover fire that we could possibly have. Right? Because the reality is in the experience. And so when people try it, even if they're skeptical, you can't deny what's in front of your face, right? Like, so, you know, if we have the right incentives, and this is why we did this trading competition, there's a bunch of people with very large audiences that are going to experience this, and they're going to go, I'm sure some of them are like, sure, this is going to be terrible. It's on Ethereum. It's going to be slow. And, you know, there's even some Solana people who are in the mix, right? Who are going to, you know, have contractual obligations to FUD it. But when you see what the actual experience feels like, you can't deny it. It is a really good experience. And so, you know, my hot take is it's actually protected us a little bit for the last 6 months while we've been building this, that no one really takes it seriously.
I love it. And before we talk about the trading competition and everyone who's involved, and there's some big names here that are involved, what are the benefits of hosting this on Ethereum? Why did Synthetix choose to come back? You mentioned kind of the security of it, the nature of it. You have the off-chain matching engine, but what are the benefits that you get from hosting the collateral on Ethereum?
I think the first benefit you get is not having to convince people to bridge.
Okay.
Like just the most obvious, easy, laziest part of it is people have a ton of collateral on Ethereum, and if they don't have to bridge, it's just one less thing they need to think about and reason about and worry about in terms of risk. So, you know, it's just a contract running on Ethereum, just like the OG DeFi days. It's as simple as that, right? So that's the first thing. I think the second thing is that, you know, there is this growing institutional adoption, right? And as we've seen, there's a big fight right now between Solana and Ethereum to attract that institutional liquidity. And, you know, being credibly neutral is one of the really important components here, right? Which, you know, isn't to say who's going to win, but I do think that Ethereum has a lead there in terms of mind share from you know, institutional adoption. And so bringing institutional market makers and people like that, you know, which is not day one, but it's, you know, day 365 or something like that, is going to be, I think, you know, much easier picking one of the L1s that is, you know, again, incredibly neutral and, you know, has Lindy and people are confident in. You could pick Solana, you could pick Ethereum. I don't think there's many other options.
Right. Yeah.
Realistically, right? As soon as you're like, okay, come over to our L3 that's running on Cosmos, it's like, yeah.
No, then you come full circle. Then you're back at the bridge risk that you described first and foremost.
Agreed. Yeah.
Man, let's talk about some of these traders. As far as institutional market makers, you've got some guys that might even qualify for that. You've got a prediction market live on Polymarket. Avenji is certain. Oh no, 𝘱𝑒𝘭𝘐𝑜𝘵, who is
Ewgeni
from Wintermute.
Yeah. The funny thing is, we're not going to have APIs on day one. We have APIs, but we're not going to let people trade by the APIs. They literally have to click. So I don't know the last time Ewgeni was sitting there in front of the computer clicking buttons to trade, but it's going to be funny. We should live stream it.
Absolutely. Hey, let's host it at the Rollup. We'll live stream it. What are the rules before we get into what you think could happen during this trading competition? What are some of the assets? When does it start? How long? Is it based on size? Is it based on relative returns? Yeah. What is the general structure for this competition?
So the structure is, it's an even playing field. It's the main net production trading venue that people will be trading on. But the way that we've done it is given everyone margin in an account that we have basically created like a sub account for, right? So a delegated trading account. So they have delegated access to this account to trade. They have 100K in which to trade. Everyone starts with the exact same capital. So, you know, Ewgeni can't just YOLO $1 billion in there and you know, make one trade. So everyone starts on an equal playing field. It is based on pure ROI. So whoever has the highest P&L at the end of the competition, given everyone starts in the same place. There's a few fun little tweaks to this. We're going to give people half the margin up front, just so they don't blow themselves out. And then half after 2 weeks. So it goes for 4 weeks. 14 days in, they get a top up of margin. But if someone does blow themselves up, we're going to have a daily vote where CT can vote whoever they want back in, and they get a rebuy of 10K of margin, right? So there's some like, you know, if you're Ansem and you think you can get your followers to vote you back in every day, it could be worth early on just like swinging for the fences.
Going all in, yeah.
Going out, then you're going to be fine.
And so every day CT is going to be able to vote on who they want to come back into the contest.
Yeah, based on who's been liquidated, right? So if you're below, I think the rule is if you're below 1K of margin, you can get voted in for a top up of margin 10K.
Yep, got it. Okay, we're gonna go down the list, but there's a pretty obvious place to start. You're bringing 𝘗𝘗𝘦𝗴𝘃 out of retirement for this trading competition.
Yes.
Tell us that there's just insane lore around 𝘗𝘗𝘃𝘴𝘃. How did you get this guy to come out of retirement? So,
this lady, because it's a 70-year-old North Korean lady. So,
right.
So that's important.
So you went to Kim Jong-un. You know, you discussed it, and
it was a tough visa process, but we were able to get VPN access over there in Pyongyang. So look, you know, I have a very good and long-standing relationship with 𝘗𝘗𝘃𝗏𝘃. You know, the degen part is obviously, you know, very clear. The Spartan part comes from Synthetix, right? Synthetix Spartan. So, you know, it was 𝘗𝘗𝘃𝗏𝘃 that coined the Spartan meme, if I remember correctly. So that whole arc where, you know, there's probably 5 people that became very, very high profile, you know, if not main characters that came out of the early Synthetix ecosystem. Mainly because we were the only community that was still alive at the end of 2018. Like early 2019, it was really dark. Like Synthetix Discord was like the only place where you could still actually find some people who were still breathing. So we had like Arthur 0x came out of there, and Bang, Rip. 𝘠𝘠𝘬𝘃𝘠, Alex from Nansen.
Oh yeah.
There were people that came out of the Synthetix Discord that cockroached their way through the bear market and came out on the other side. So yeah, I pinged 𝘠𝘠𝘬𝘃𝘠 and said, hey, we're doing this thing. So yeah, you won't be getting them on the Rollup anytime soon, but they'll win the comp.
Yeah. Hey, we can live stream with the PFP. That's no problem. Okay. So 𝘠𝘠𝘬𝘃𝘠, I mean, criminally undervalued at 6%. No one's really.
I think people must think that they're washed at this point.
At this point, I mean, he's probably a little rusty. He, she, they is probably a little rusty.
Yeah.
On only $150 of volume, the leader right now, 𝘗𝘯𝘷𝘦𝘴𝘵 at 27%.
That's someone betting on themselves.
For sure.
I don't see any other alternative there, but we'll see. Maybe I'm wrong. Maybe someone's got the alpha. I don't know.
Right. Someone might have edge there. Okay. Some other names here. DeFi Dad, friend of the show, great guy. 𝘗𝘳𝘰𝘮𝘂, another one who could potentially vote himself back into the program.
𝘗𝘳𝘰, if I were 𝘗𝘳𝘰, I'd be swinging for the fences, if just for the lulls, first of all. But I think decent chance of getting voted back in. If he blows himself out. And
the asset universe that's available to these traders during the competition is really anything on Synthetix, right? Meaning Zcash, Bitcoin, ETH. This is all fair game.
For the starting point, because it is a new exchange. So the old exchange had, I think, about 60 markets, which has been deprecated now. The new exchange is going to start with 5 markets, but we'll be rolling out new markets. And we may or may not allow some of those markets to be voted in by CT. So yeah, Zcash, I think, has a decent chance of getting in there. There's a few other assets that I'm sure people would love to trade. So we're going to be working hard to add new assets all throughout the competition, throughout the 30 days. And yeah, my expectation is we probably end with about 20 or 25 markets.
Oh, we're going to ramp up quick then. Okay.
Yeah.
So we'll start with 5. Okay.
Start with 5.
About 15, 20.
Yeah. I mean, if you want to go, like, Doge is probably the most degen asset, I think. The other ones are majors. So
yeah. Okay, cool. And general question, as far as your strategy, others might have, their approach. Would you suggest that, over a 4-week-long competition, are we going to see people trade the 1-minute chart and go tick for tick, or are we going to see one trade just could be hold Bitcoin wins the competition?
Yeah, I mean, if you go, 2-3x leverage, timing's obviously interesting, right? Because we had that little dip to like 104. It would have been a really good time to start, but now we're sitting at 110. It's like, ooh, that's a bit tough. I don't know if you just YOLO 3x and hope we get back to 130.
It would have been a really fun time to start because we would have seen a lot of big numbers, but this time frame right now, and it makes it harder, and it's really going to separate the men from the boys, or the 70-year-old Korean ladies from the boys.
The monkeys with a keyboard, exactly. Exactly.
So
yeah, it's gonna be very interesting. It's a choppy market at the moment. It's tough to trade chop. I'm gonna be trading like fairly short time frame, like usually like 1 to 2 hour time frame. So we'll see. But yeah, it's gonna be super fun.
Yeah, I'm looking forward to it. When does the competition officially start?
We should be live by the time this
should be live right now. Yeah. Very cool. And so these odds on this prediction market might change. Another big name here who's done well over the years but has crashed out as of recently, 𝘂𝘪𝘵. He's got an XRP tattoo. Do you think that's going to serve him well?
Yeah, I mean, look, we'll get XRP out there for him, and he YOLO XRP. As someone who I just bought 𝘂𝘪𝘵 in boxing, and
oh, that's right.
Yeah. So it was a pretty bad loss. So I'm looking forward to trying to ride the ledger, at least on the trading side.
All right, 𝘗𝘯𝘓𝑚's revenge arc starts now.
100%.
All right. And so you're participating in your own competition. I think we're going to see how that plays out. But I'm also curious, if you don't win, who do you think is going to do well? Like who are some of your top picks for who you think is going to come out on top here without saying yourself? Yeah,
I think there's definitely some people who I know are pretty good traders who are kind of dark horses. So I think he should be on the list now, but 𝘠𝘬𝘃 was a late entrant.
Okay.
He's a pretty decent trader. He's a very kind of I think he's just going to like probably YOLO max ETH. And I'm pretty bullish on ETH. So I think if he goes like 5x ETH long, he'll do pretty well. So I think there's going to be some people who maybe have like some idiosyncratic trading strategies. And you know, if we do rip a bit higher over the next 30 days, which, you know, my hot take is we will.
And what I'd love to, yeah, I'm curious, what's the justification? What's your basis?
So our head of liquid trading at 𝘠𝘪𝘵, my prop fund, and I 3 weeks ago were like, the only thing that is holding us back from a parabolic run into the end of the year is a big washout. And then we got that little washout where everyone was like, okay, that was it. And I was like, I don't know if that was enough. And then we got Black Friday, and I was like, that was maybe too much. But I think, you know, you cannot possibly go back to up only without flushing out some leverage. It's just not possible, because if people have a ton of leverage sitting in the system that's in profit, they're just going to take profit all the way up, all the way up. You have to flush out the people that are going to be scalping you, and just replace it with people with like giga conviction. And once you flush out that leverage and you've got people that are just super high conviction, who bought the dip or whatever, then it's much easier to run up from there. And you know, we see it every single cycle. There's a big flush, everyone freaks out, it's choppy for a little bit, and then back to up only.
So there's not one particular catalyst. It's really just this big leverage wash, and now the capital base of holders in ETH is stickier than those who were just trimming profit all the way up.
100%. And you know, like, this is again a very well-known setup, right? Like, we're in a bull market. It's very obviously still a bull market. Everyone's trying to call the top. The more people who are calling the top, like, it's fatigue. People at the end of a bull market want the bull market to be over. They want to go back to, they think they want to go back to a bear market. It actually isn't very fun, but they think like, this is, you know, this is tiring, right? I'm like terminally online. I've got to be online 18 hours a day so I don't miss things. Crazy shit's happening all the time. Coinbase just bought Kobe's up only NFT for 25 mil. Like, you try and tell me that this is not a bull market and crazy shit. Like, I'm sorry. Like, you're like, that's cope. It's massive cope. So, you know, we're in a bull market. We had a massive flush. Everyone's a bit fragile. They're walking on eggshells, and I think we're going to keep grinding up, and we're seeing it. It's already happening. Back over 110. I think it's up only from here. You know, a couple of interest rate drops, like, you know, 150 Bitcoin at the end of the year, 200, 250 is not out of the question in my mind.
Beautiful. I mean, don't overthink it, guys. Basically, just don't overthink it.
Yeah.
It's right in front of us.
Here's the thing. You will not know it's a bear market until 6 months after the top. That's the harsh reality. It takes 6 months after the top before people actually are convinced that we're in a bear market. Like, a little correction and you're like, oh yeah, we're in a bear market. Like, get the fuck out of here. Sorry.
Right. Big leverage wash. People are calling for the top. Okay, a couple other names that are just we could not miss while we're discussing the competition. 𝘗𝘗𝘵𝗦𝗡𝗥, a main character of a more recent era, very recently had a call publicly. Didn't necessarily, I mean, very vague. This guy's kind of mysterious. Do you also have a relationship with 𝘗𝘗𝘵𝗵? What's the lore behind the Synthetix 𝘗𝘗𝘵𝗵 collab?
So 𝘗𝘗𝘵𝗵, not with that handle, but was in the Synthetix Discord. So I've been talking to him recently, and he's got some Synthetix lore. So I don't know exactly who this person is. My suspicion is there was someone fairly high profile in the 2021 cycle, and then they rotated their handle or something. Like, there's something going on, because I don't remember 𝘗𝘗𝘵𝗵 being in the Synthetix Discord. So unless I'm very mistaken, I think that they must have been operating under another handle.
Very, very interesting. Kane, I think that's all that I got for you. There's definitely some sleepers in here as well. I wouldn't be surprised if 𝘗𝘠𝗦𝘧𝗏 is just savvy. Wouldn't be surprised if he makes it towards the top.
Yeah, if we can get 𝘭𝘭 in there for him, I think he's got a good shot because he'll just full port 𝘭𝘭, and then if at the end of the day, if the next 30 days are up only, it really comes down to who is degen enough to go deep and high leverage, and if they can get access to some more reflexive assets, which I think we will try our best to add.
Okay, and what is the maximum amount of leverage available on Synthetix?
100x.
100x.
Yeah.
There's plenty of room to have some fun here.
Oh yeah, absolutely.
Beautiful. Kane, thank you so much for coming on, man. It's absolute pleasure. Really looking forward to this competition.
Amazing.
That's the